sense of the White House's thinking here on these oil markets is complicated, because they do feel that it is a boon for the economy in certain sectors if oil prices are low. On the other hand, they fully are aware of the damage to the fracking industry and others from those low prices. And so they're trying to balance both of those in their considerations here. Not clear they're thinking about taking any action in terms of the oil market specifically, but we should have a better sense of things, Kelly, after this meeting at the White House once the president gets back to town.
Okay, Eamon, we appreciate it. Thanks, Eamon Javers.
You bet.
And traders are now betting on another massive rate cut from the Federal Reserve as early as next week, taking us closer to zero. Steve Leisman has more on that. Steve.
Tyler, thanks. Growing concern about the way fixed income markets are trading has some market participants saying that the Federal Reserve may need to do much more than just cut interest rates. There are calls for them to break out some of their programs from the financial crisis to resolve liquidity problems. Kelly and I just sat down with Bob Michel, head of Global Fixed Income, Currency and Commodities at JP Morgan Asset Management. We asked about unusually large bid-ask spreads in the Treasury market. Here's what he said.
Steve, I've been doing this 40 years. I've never seen that before. Last night, I got a message from our London office. There was no offer on the 30-year Treasury futures. We've never seen that before. So these are uncharted times for sure.
This morning, the New York Fed announced it was increasing the size of its overnight repo operations to $150 billion from $100 billion, providing liquidity into the market. It upped the amount of its two-week repo to $45 billion from $20 billion. That prompted former New York Fed official Krishna Guha, now at Evercore ISI, to say, quote, "It is a baby step with only short-term changes, limited-term funding, and no global reach. In our view, much more will need to be forthcoming, and very soon." Market participants I'm speaking with calling for the Fed to cut 100 basis points over the next two meetings. Barkley just out with a paper calling for that. Loosen some regulations for banks that might enable them to provide additional dollar liquidity to the markets, and other crisis-era liquidity programs to provide more funding into the markets. Luckily, the Fed has converted what were temporary into standing dollar swap lines with Canada, ECB, England, and Japan. And those dollar swap lines should enable those banks to borrow dollars as needed to resolve any dollar funding issues that may come up. But it just seems like it's taken a step towards the worst today in terms of the interbank thing that seemed like it was okay last week. I'm just hearing more alarm now. I don't think it's DEFCON 5 at this point, but I think it's worse than it was on Friday.
And it was interesting to hear Bob Michaels say that despite all the kind of extraordinary central bank stuff we're talking about now, that we said if a big targeted fiscal stimulus plan came out tomorrow, what would happen? And he said it would stop all this in its tracks.
There is nobody who I've spoken to who has not said that the primary response here needs to be fiscal. And by the way, that includes at least 4 Federal Reserve officials who spoke on Friday at the Shadow Market Committee. They were very strong in calling out, and they normally don't do this, the idea that from a public health standpoint, from a fiscal standpoint of addressing the economic fallout, this needs to be a fiscal response, as it will be more effective than what the Fed can do from the economic growth point of view. From a liquidity point of view, I believe that response has to come from the Federal Reserve.
Yep, 10 years back below 0.5% now, 8% drop in the Dow. Volatility, the new normal on Wall Street. Over the past week, these 1,000-point swings have become a daily occurrence. And today's sell-off was so bad at the open, it did trigger a trading halt. What's wrong with this market? Here to explain is fast money trader Guy Adami.
Hi, Kel, Steve, Tyler. Listen, I'll try to explain it. I want to say quickly, I mean, I've been doing this now. I've been with Network 13 and a half years. I can speak for myself that none of this is fake news. And I think I can pretty much speak for the network. None of it's fake news. I mean, we are reporting what's going on. Some of us have opinions. Reporters report. I just want to put that out there because I think it's important. I'm also not an economist. I'm not smart enough to be an economist, but I think I sort of understand what's going on. And I think history is littered with disastrous outcomes born of really good intentions. And I think we're seeing it now. I think in the 80s, Mr. Greenspan said, you know what? maybe we can take the recession out of the equation. And they were able to do that for a period of time. But I happen to think recessions are a natural part of the cycle. It's like the forest. Old trees burn down, new trees grow. It's unsightly, it's devastating, but it's essential. It's the same thing with our economy. And what does that mean? Well, I'll sort of tell you what it means. They put in place these things and people get lazy. How do they get lazy? Well, I think in many instances, corporate America got lazy. Give me an example, Guy. I'll give you two, and not to pick on a company, but I think General Electric got really lazy. I think IBM got really lazy. Why? Because they borrowed money cheap, they bought back stock, they paid their dividends, and off they went. Now they're coming home to roost. Everything's sort of coming home to roost now. I think, again, it's making people now focus on their businesses. What does it mean in terms of volatility? Well, for a long time, market participants bought options as protection. But when they saw the market just goes up every single day, they said to themselves, why bother? Why do I need to do this? It's just a cost I don't need. So they stopped. Then they said, well, wait a second. Maybe we can sell options. Instead of buying these things, instead of not doing anything, we could sell options. The market's never to go down again. We'll create this synthetic dividend for ourselves, and everything will be fine. So whether they realized it or not, or intended it or not, the Federal Reserve and other central banks dampened volatility to a point that was unnatural. And I'll give you a really good example, and this plays into other things like passive investing. The weekend that Apple came out and said, you know what, things are going to be a little rough because of what was going on in China. That's fine. That's absolutely fine. Next day, the stock went, I think, from 322 down to 315 or so. Not a huge move at all. Next day, stock's trading right back at all-time highs. What does that mean? Market participants got lazy. And this passive investing looks past all the news. Now, again, we're seeing what the manifestations are. In terms of the option volatility, you're seeing what's happened when people have what I call and what market participants call negative gamma. What happens is the lower the market goes, the more they have to sell, which exacerbates the downside, and the same thing happens to the upside. And we've seen it a number of times over the last couple weeks. The bad news is that doesn't get sorted out overnight. Unfortunately, it doesn't happen. This is 5, 6, 7 years worth of this going on that needs to be sorted out through the system. So that's what I think is going on. I'm not here to call a bottom. I'm not here to assuage concerns or stoke any investment fears or those types of things. I'm just trying to explain to you what's going on. And quickly, you know, the administration wanted lower oil prices and they wanted lower rates. Well, guess what? We got them, and look what's happening now. Last point, and we've said it on Fast Money now for a long time. I thought 1.4% in the 10-year was the point of diminishing marginal returns in terms of what it meant for the stock market. And look and see what happened when we went through 1.4%. See where we are now. Bond volatility, bond volatility is historic, and it's been going on for years, yet nobody talks about it. And currency volatility is historic, and it's been going on for years because nobody talks about it because everybody's so equity-centric, and I understand that. But it's not healthy. And the last point, you tell me, go back to September, the Fed repo, when they said this is normal business as usual. There's absolutely nothing normal about what happened in September. And as we're now in March, what's going on now? They could say it's normal. That's fine. That's their prerogative. But if you look under the hood, something is really very wrong, and it's manifesting itself now. Sorry to take the last 5 minutes.
In just a quick word, because you manage money, what do do investors do then? So all this being the case, it's still the market that we have. It's the market we have to live with.
What's funny is, so we're down 19, if my math is correct, Ty, I think we were just looking at this, we're down 19% from a historic high in the market. 19%. That's, you know, we've seen that before. The problem is we're seeing it in the course of a week and a half, and it's freaking people out. I mean, that's what happens when volatility gets tapered to the extent that it is. There's nothing normal about this, I get it, except that this is the new normal. And I'll say this, and quickly, Ty, and I know Steve is still here. He's going to absolutely disagree with me. I'm one of probably handful of people on the planet. October 2018-19, when Jerome Powell was saying, you know what? We're going to reduce this balance sheet. We're raising rates. I happen to think he was doing the right thing. You know, why follow everybody else down the rabbit hole of raising rates when you don't have to? If our economy was as strong as the administration said, there was no need to do that. And I think we'd be in a much better place now. I can't do the counterfactual. I totally get that, and I'm not trying to. It's just my opinion.
So the reason the volatility has gone away is largely what? The
I think
Fed?
2 things. Passive investing is dampened volatility, and central banks. I think, again,
Central banks protecting us from
what are they protecting us
ourselves.
from? So what are they protecting? You know, in my opinion, the Federal Reserve's job is not to make the stock market go higher, right? It's not. I mean, I understand that they sort of need to. And again, this is just my opinion, but consumer optimism through the roof until recently. I think all consumer optimism is an overlay of the S&P 500. Not to suggest that everybody owns stocks. That's not my point. But when people see the stock market go up every day, year after year, they say to themselves, the economy must be strong. If the economy's strong, I can go on that trip. I can buy that Starbucks coffee. And that's our 73% of that economy is exactly that. Go back to October 18 and October and November of 19 when the market went down 19.8% in a month and a half. Consumer spending stopped on a dime. And then they realized we have a real problem here. We can't normalize because it's going to upset the market. If it upsets the market, it's going to upset the consumer, and we have a problem. And that, I think, is what you're seeing now. Again, I'm not suggesting I'm right. It just happens to be my opinion.
All right, Guy, do you want to jump in, Steve? You have a thought here?
I just wonder the extent to which we can have one discussion about it being a buying opportunity or not when it's a credit event. I feel like when it's a credit event, it's no longer a discussion about should I come in on these lows. I think you have to wait until credit markets clear. I think discussing the sins of the past might be relevant at some future point. I think that that's an interesting discussion. I was with Guy in the idea that maybe I would have liked to have the Fed to gone as high as it possibly could for instances like this, so that it had more to cut,
had more
a bigger
cushion.
balance sheet, a smaller balance sheet, and higher rates. That was not to be. I was not a huge fan of the 3 rate cuts that came in response to the trade war. But that's where we are. And you go to war with the Fed funds rate you got, not the Fed funds rate you wish you had.
All right.
And now the question is getting the market through liquidity issues here so that you can have price discovery and get to that point where investors can have the discussion, is this a buying opportunity?
All right, everybody stay put. Scott Wapner has joined us with some comments from the Bond King, Mr. Gunlock.
Well, thank you, by the way, because it's relevant. I'm here really because of what Steve is talking about. So I asked, Jeffrey, if we could talk about some of these issues that are happening in the credit markets, as Steve was describing these dislocations, between the bid and the ask spread on treasuries. So I asked him specifically about that. He said, and I'm going to quote here, and I think we have some of these, if not, I'll put them up afterwards. The absolute move is so big, he said, that one should expect an expansion of the bid-ask spread. He didn't come off to me, Steve, as
It being a liquidity.
all that surprised, I would say. Not that he's not concerned, but he wasn't all that surprised just given what we're seeing. He said on stresses in the credit market, he said these things are kind of shockingly orderly. He said even investment grade corporate market is pretty orderly. Given that every single market is down big and the treasury market is up big, given that context, the credit market is more orderly than you might otherwise expect. Okay, just because of what you're witnessing across the board in the market. I said, well, how bad could it get? How concerned are you? He said, well, I am concerned. Things have to get worse, he said. You don't have a move like this end without disorder. It just never happens. That's what he said. In terms of what the Fed may do, he said, these calls for more Fed action seem early to me. The stock market isn't even down 20% from its high. So you can address those in any form of
counter
fashion.
that with what I heard this morning from somebody at a major investment bank who told me that the ability of Japanese banks to swap into dollar assets, and they do this cross-currency thing, was 30 basis points. It's now 120 basis points. Things with Europe were like 5 or 10, and now they're like 30.
And he doesn't he doesn't dismiss that, or
here.
He not at all. And
Right.
he to your point earlier about
And
opening up these swap lines, that was sort of met by Gunlock to me. Well, of course, sure, I could see that, but that
you can tell Jeff to rest easy because I checked with the Federal Reserve. Those swap lines are actually open. They were converted from temporary to standing facilities. So if Europe or Japan want to borrow in the dollar swap line, they may do so pretty much at their leisure.
I mean, I think the bottom line here is that while he's concerned about some things he's seeing in the credit market, it hasn't reached DEFCON 5, if that's the
I think
highest,
it's
or
DEFCON 1 is the
1, whichever
highest.
way it is. I
Thanks to a
can't
viewer.
remember for watching war games.
Yeah.
Whatever level that is that marks the highest point of stress and concern, we're not there yet, but goes on to say that you never have a situation like this end in anything but. It's just a matter of what ultimately gets you there, whether it's the stock market having that whoosh, which when, we sit here and we watch the market today and a 7 or 8% move feels like a whoosh.
Feels like a
That's
whoosh.
not what he was talking about. You could get a 15% move in a day, which is the ultimate thing that puts you in a place of real fear and worry.
Let me respond with what I think the Fed would care about. Stocks falling, not really a big deal. Yields falling, not really a big deal. What they care about are people who are leveraged into all of those trades. And those people losing money is not really a big deal. I think their biggest concern is, does it create systemic risk? Do we find out ex post that the risk that we thought was not in the banking system is in the banking system? There's no indication of that right now. In fact, banks acting to preserve themselves makes the situation worse in the sense that they keep dollar funding from the market. So they husband those resources because they're either because of regulatory reasons or their own concerns and their own models tell them, hold on to this stuff, don't provide it. That's how you get to that place where there's a real concern. And I agree, we are not there. What I have heard is market participants telling me there are some dislocations out there. There are some indications of some of these things that we saw back in 08 and 09, but not on that extent. And we are not yet, there's no information, and I hope it's not true, and I don't think it is true, that the risk is going to be found to be lying back in the regulated banking system.
Let me ask Guy a final question here to go back to a lot of the points that you were making, and with the context now from Jeff Dunlock about what he kind of is or isn't worried about out there. Is there anything that somebody could step up today and do or say that would make you feel like, hey, my concerns are being addressed about this market. We're going back to the good old days, not the bad old days. That
Interesting.
sort of thing.
That's a great question. So I'm 56 years old, and when I was a kid, there was a great commercial. That's it. I appreciate that. If I'll dye my hair, I'd look a lot younger. But there was a commercial. It's not nice to fool with Mother Nature. And what's the point? That's exactly what's been going on. Let this system, let it run its course. Let things happen. It's painful. I get it. But again, I don't think it's about where rates are. It's about liquidity, right? So you can drop rates as much as you want, but I don't think that's helping the problem. To me, it's just making it worse. To Steve's point, yes, I understand the Fed didn't want to create that, but that's exactly what they created in terms of leverage. And I would say one other thing, and I know I'm going to get added at on Twitter, I don't think the problems from 08, 09 were ever solved. They just got moved, and they got moved from banks' balance sheets, which are probably looking pretty good right now, to Steve's point, to the balance sheets of central banks, which are totally inequipped to handle. And last point, and I don't think the Fed thought this through as well way back when.
Guy, I got to interrupt you. There's just no evidence.
Well,
there is
no evidence.
that the problems were moved to the.
It's an opinion.
But there has to be some basis.
Yeah.
To
Well,
it.
look at the expansion.
How is it possible for you to say that the problems from 08, 09 got moved to central bank balance sheets?
Where'd they go? They just vanished. They got better.
No. I thought you were going to say what actually did happen, which is they got moved.
Come on.
Let me finish. They got moved outside of the banking system, into the non-financial, and into the non-banking system, into the shadow banking system. That's precisely where they were drawn, and that's precisely a question that we have about the extent to which the risk is there right now.
No,
but I don't see how they were on the central bank balance sheets.
It's again. Well, we got to go to commercial. I know. I mean, just look at the expansion. Our Federal Reserve balance sheet expanded at a ridiculous pace. I don't think that's in any way healthy. But again, we can agree to disagree. These are just opinions. I'm not trying to state fact other than the fact that in terms of vol and what's happening in terms of derivative books. I think, and if you want to bottom, if you want to know when this thing is going to end, my opinion, it's when you walk in one day and say some derivative book somewhere absolutely blew up. Then I think you're going to have at least somewhat close to a bottom. Until then, I think this thing continues.
And you're sticking around. We're not going to any commercial breaks, so don't worry about that. Scott, thank you very much.
Yeah.
Steve, we appreciate it.
Steve, you asked me, well, I wonder what Gundlach's thinking, so now we know.
Now we know. Stocks are hitting session lows in just the last couple of minutes. With an unprecedented drop, the major averages are now down about 19% from their record highs just last month. The question is whether this puts the end of the 11-year bull market within reach. And on that note, let's bring in David Kelly. He's Chief Global Strategist with JP Morgan Asset Management. And Russ Kosterich is Portfolio Manager with BlackRock's Global Allocation Fund. David, let me just start with you. You're probably champing at the bit to jump in here on the central bank debate. What do you think the main problem is with the markets today?
Well, I think it's uncertainty actually about the economy, which we're not really talking enough about. But I think what really happened is, as these numbers of cases have increased, people realize that more and more companies, more and more individuals are changing their behavior. That's causing social distancing. And if you look at the numbers on consumer spending, you can easily sort of put a hit into hotels, airlines, restaurants, and so forth. And you can easily come up with a recession which starts in the second quarter. And I think that's really where the problem is. But for investors, just calm down. Markets are crazy in the short run. In the long run, they are dictated by economic fundamentals. We may have a recession, but we've seen a big fall in stock prices to date anyway. And if we have a recession, eventually the coronavirus itself, its effects will fade. I think the effects will be very, very big around the world before we're done, but they will fade. Then the economy will come back. And so I think people should look at valuations carefully, make sure they're appropriately diversified, but just don't get too focused in these short-term market moves. They may be saying something, but I do believe that central banks can deal with the financial stuff here. It's really the economic stuff we've got to worry about, and there's some limit to the downside there.
So, Russ, what is, in your view, the economic risk here? Have we even begun to see it?
The economic risk is real. I mean, we're seeing this as a very unique economic shock for a variety of reasons. One, it truly is global. Second of all, it impacts both the supply and, as David just mentioned, the demand, and it is very hard to quantify. And for all those reasons, I think people are understandably concerned about the economy. Most people came into 2020 with the view that the global economy will not great with stabilizing. This certainly changes that narrative very quickly. And it's not inconceivable that you could have a quarter or two of a contraction. But I do agree with David. I think that the risk here is about how much the economic environment changes. What does that do for earnings? And how, if at all, can policymakers respond? I mean, so far, we've seen from central banks, I think there are legitimate issues about liquidity, but really the key here, other than a deceleration in new cases, is going to come from the fiscal side and targeted actions that help both individuals and companies that are made vulnerable by this shock.
David, on that note, we know that now that we're going to have Wall Street execs at the White House tomorrow. Of course, I think this evening, Eamon Javers had reported that Trump's advisors may be presenting him with some fiscal options. What would you like to see announced?
Well, a few things. First of all, I think we need to give the effective medical insurance against this disease to everybody. I mean, I don't know how you do that through an expansion of Medicaid, or maybe you just find some other way of funding it. But I think anybody who wants to get a test should be able to get a test. People should be able to deal with it. So we need to deal with short-term the medical issue. Second of all, I think we need to look at the businesses that are being impacted, particularly small, medium businesses. Think about small business administration loans. Think about helping companies weather the storm. And third, we need to think about the low-income workers, because a lot of the workers in the service sector are low-income workers who will be hit by this. Can we do some sort of stimulus check or something, maybe $1,000 per person or per household or something, but just a very egalitarian kind of tax cut, which really helps lower-income people to give those consumers some money to get by if, unfortunately, they do lose a job or lose hours because of this. So I think that's what you need to do. You need to protect small companies, protect vulnerable individuals, make sure you're dealing with the healthcare aspect of this. I think that's the best you can do in terms of helping ride out the storm.
Okay, we're coming up to the oil close, guys. Got to run. David Kelly, Russ Kosterich, thank you for your thoughts today, and we'll see what we do here from the White House. But as we hit half past, today's market sell-off has been triggered by a huge drop in the price of oil as Saudi Arabia and Russia get into a price war. Right now, oil is closing up for the day, and we are down about 24%, just over $31 a barrel. That's That's the worst single session for oil since the Gulf War in 1991. Now, this move, as you can imagine, is wreaking havoc on the energy sector. The whole group is down 19%, which would be its worst day ever. Let's bring in Brian Sullivan for more on all of this. And also joining us here on set is Damian Kervelin. He's head of energy research at Goldman Sachs. So welcome, everybody. Brian, your thoughts?
Hi. Yeah, I wrote a piece over the weekend. It's still up. It's an epic battle of egos. Remember, we put sanctions on Rosneft. Rosneft is run by Igor Sechin, Vladimir Putin's best friend. This is a payback to Trump from Putin. The Saudis are ticked off to the Russians, who my sources tell me were never interested in making a deal. They never even got close in Vienna. Russians probably just showed up to say that they showed up. And this is what we get. I think that polling people today, and I'd like to hear Damian's thoughts on this, I don't think it's hyperbole to suggest that at these prices, 40% of all oil being pulled out of the ground in the United States right now is losing money.
Does that mean it gets shut down?
Well, if it doesn't, I don't know what's going to happen. I wish I did. There's all these things that we don't expect. But I will say, if you're losing $10 a barrel,
then you better pump twice as much, is my point.
And I think that we're going to have to see the industry shrink. And the equities, by the way, are reflecting that. You don't need my opinion on that.
And there are some of them right now. You can see them down 40% from recent highs.
Damon, what do you think about how this will ripple across the energy sector? Brian made the point last week that a lot of the stocks were already trading like oil was at 25. We're actually at 30 or so right here, and yet you have the stocks falling 30-40% today. So what is that telling us?
So I think the key takeaway here is the structural component of this lack of an agreement, right? Sure, it is surprising that they couldn't agree in a recession to cut, but ultimately it's not unexpected in a way, because since 2016, they've made an artificial cut, which was not in their economic interest. And I think what you may be seeing on the equity side, which is taking a long-term view on the sector, is ultimately we may be unwinding this uneconomical cut. Think of it that way. Since 2016, OPEC and Russia production is down 4.4 million barrels per day. The rest is up 5.7. At $60 oil prices, that's $200 billion wealth transfer every year from one sector to the other. So I think what the market is saying is, are we finally moving back to what would be the rational market structure? Low-cost producers, namely Saudi, Russia, growing production over time, and the more marginal producers that indeed do not work at those prices, simply not having to be around for the next several years.
But even if it goes back to Russia and Saudi, they're low-cost producers, sure, absolutely. But they have high break-evens for their budgets, do they not? So sure, even if that wealth transfer goes back, they come out ahead, U.S. shale production goes down, and oil's where? Still $40 a barrel? I mean, doesn't that still hurt their finances?
So in the short term, that's always the case. It's always better off to cut production to support prices for both economies. Although Russia's break-even is $45, whereas Saudi's is somewhere between 80 and 85. The key, though, is let's look 3 years from now, right? If they do manage to increase production and prices recover from here, maybe it's not 60, but even if it's 50, 55, by then both economies are better off, right? Saudi's fiscal deficit is at least half as small by 2022 than in this kind of flat production, stable price environment. So that's why, there are long-term economic benefit to doing this market share defense, and now is an opportune time to do it.
But they want us gone. Don't you agree?
Yeah, they want to squeeze us.
Yeah, we're the high. We're the
ones who have increased production,
correct,
even as they have
4 million barrels a day out of U.S. production has come online in the last 2 years. And if you're Russia or Saudi Arabia, number one, you can print money. Even Exxon can't do that yet. And number two, you're looking at the global oil market and thinking these high-cost producers who have been living on debt, who just got here a couple years ago, are screwing up our market. I'm not saying I agree with that view, but that's their view. And they know how weak they are. And maybe
the weak hands
that they can squash the industry.
Quickly, there's one other thing we have to bring up, and Brian's been on this. We've talked about it on our show that Brian's been doing a great job with. This whole ESG investing is a complete existential risk to the entire space that came at the exact wrong time for all of them. And I can't tell you, it is a big deal. And just look at ExxonMobil in an environment when it should have been trading higher was not. Now, obviously, things are going pear-shaped. I get it. But if you don't think ESG has anything to do with this, you're just not paying attention, and that's not going away.
What about the tobacco stocks, though? I mean, there was huge divestment that led to huge returns for those stocks. So I totally take your point. There's massive capital coming out of the energy space, but is it really going to stop or slow down production?
It takes time, though. It didn't happen overnight.
Yeah.
And things move so much faster now than they did when that happened. So listen, it will sort itself out, but this is happening in terms of the ESG, it's happening at light speed, right before our eyes every single day. To your point, it will figure itself out, but it's not going to happen tomorrow.
What percent of the shale producers in the United States are going to be here in 5 years?
So, I think when you look at the structure of shale, there's about a third of production that comes from very small producers. In the Permian, there are 100 of those small producers. And I think that's the key, right? When we say high-cost producers, first of all, it's not just shale. You have other countries that are high-cost producers. But in the case of shale, it's really moving away from a fragmented industry funded by external capital to grow quickly, which was at the time what was needed, to a rationalized industry with fewer, larger producers with much lower cost of capital. So that's a transition that had to take place anyway. It was drawn out over the last 4 years.
Question for you, though. So we're watching the price of everybody in the energy sector down today, and the one thing everyone seems to agree on is consolidation. So why aren't the smaller players, and we know in a vacuum the smaller players look worse off.
Ain't gonna happen.
Shouldn't there be any bid under the price of these names today if they're going to be rolled up?
Consolidation is not gonna happen.
Why wouldn't it happen?
Because the value of the reserves in the ground have no value. There's no value. In fact, in some cases, it might be a negative cost. That's the issue right now. Right now, things turn around. Maybe you would agree. I know you're not a stock guy, Damien, but you're going to be taking on a lot of debt. Now, if the debt gets restructured from some of these companies and the price of oil stabilizes, you could see it. But private equity is full up. They are maxed out on their energy investments. To your point.
What about the Exxons, the Chevrons?
But it goes back to, right,
to cut costs.
If you have excess leverage, you have to kind of buy back all of that debt to acquire the assets. So let the assets decay, and eventually the rock is still there, right?
Buy
so
the asset itself instead of the debt that comes with it.
The rock have value over the long term. The company around it may not have in this environment.
What is the overall production in the United States today in barrels of oil?
Sure. So U.S. is actually bigger because if you include NGLs, then we're nearly 19 million barrels per day. Crude itself,
natural gas liquids.
Exactly. Crude itself is about 14 million barrels.
But what will it be in a few years?
So, shale I don't think is going away, right? We're not making the case that this is the end of shale. Even if Saudi, Russia increase production, they have finite amount of spare capacity, right? So 3-5 years from now, we still need growth elsewhere. Now, the swing factor, I think, will be Libya, Iran, Venezuela, right? That can completely change the timeline. But again, 3 to 5 years from now, U.S. is still producing oil, probably at those levels, if not higher.
That's a human story. You think about Venezuela, what's already gone on there, it's just only going to get worse. And for a lot of people in Midland, Texas, there's going to be big job losses and projects that don't get underway in a state that has arguably powered the American economy. Did power it out of the Great Recession. It's going to be a rough time.
We have to move along, but David, why do you think we could be producing the same or more in a few years as we're producing now? Who's going to be producing that?
Sure. So Exxon and Chevron are still growing, we think, even at low prices. And then all those small producers that are operating inefficiently at a high cost of capital, the same assets can be in the hands of lower cost producers. So I think we're away from 1 million barrels per day growth every year unless the global market demands it. But at the same time, this is not perpetual declines from here. From a shale perspective.
Can we give a shout out, by the way, to Al Walker? Al Walker was the CEO of Anadarko. He and 5 other Anadarko executives walked away with $300 million when they sold Occidental in May of last year. So Al, if you're out there watching CNBC, you're either the luckiest or the smartest guy in the world. Congratulations.
Probably take it either way. Brian, thanks very much. Damien, we appreciate it as well. Damien Corvalin joining us from Goldman.
All right, the Dow tanks more than 2,000 points amid growing concerns about a global slowdown. There's a dire warning from PIMCO telling clients the worst is yet to come for the economy and that a first-half recession is now a distinct possibility for both the United States and Europe. Joachim Fels is PIMCO's global economic advisor, and he joins us now from Newport Beach. David Kelly, just a few moments ago, said we have not been paying enough attention to the economic effect of this virus and the ripple effects through economies. You are arguing that, boy, we need to. How bad is it going to get?
Well, Tyler, I think it's pretty clear that there's now a very distinct possibility of a recession in the U.S. Maybe that's even the base or has to be the base case now. The good news is that if a recession comes, it's likely to be relatively mild, relatively short, because there are no major economic imbalances in the economy. The consumer saving rate is pretty elevated. The problem, though, is that even though it may turn out to be a U-shaped economic trajectory, the U initially looks like an I as the economic indicators sink. Then it starts to look like an L when the economy bottoms, and only when growth bends upwards it becomes clear that it's a U. So I think we will be going through a period of elevated uncertainty. And again, the bad news in the data still has to show up in the next few weeks and months.
You know, sir, respectfully, you mentioned the health of the consumer. You know, I push back and say, consumer debt to GDP is at levels we probably haven't seen. Corporate debt to GDP, same thing. Your reply will be, yeah, but the funding, the levels of funding, the interest rates sort of offset that. But I think this is one thing I say. You can correct me if I'm wrong, and I'm wrong a lot. I think people historically they confuse the health of the consumer with their want to spend. The two are mutually exclusive. I never underestimate the U.S. consumers' want to spend. I'm not certain, though, at this time they should be.
Yeah, that's right. I mean, we live at a time of very high uncertainty. The virus is still spreading, so you would expect consumers to hunker down. And so I think you will see the saving rate go up. Lower oil prices obviously help consumers. Lower gasoline prices help consumers, but they're not going to spend these windfalls in this environment. So that's why I think this could actually become the first services-led recession. Usually recessions are led by housing or by manufacturing, but I think you'll see demand for services declining, and consumers will only, I think, become more confident and start spending if and when it becomes clear that the outbreak is behind us. And again, most experts say this is not going to happen before May at the earliest.
Talk to us about the services sectors that will be most vulnerable or most impacted. I'm not sure that's really a verb, but you know what I'm saying. In the recession scenario that you foresee.
Yeah, well, we're already seeing it in travel. Yes. So airlines are affected. We will see it, and we're starting to see it in the entertainment industry. We will see it in the hospitality industry, hotels, the restaurants. These are the areas where I think you will see the biggest fallout.
I'm curious, as a data-driven individual, what your reaction is as you look at what's happening in the economies around the globe. What your reaction is when you hear the leader of the administration say that this is all being overstated by fake news and Democrats who are out to harm him?
Well, I think if you look around the world, if you look at the data, you can already see that we've had a very sharp supply shock, a negative supply shock. It's already showing up in the Chinese PMI. We will see it in the manufacturing data out of Europe, which is very closely linked to the Chinese economy soon. We're already seeing the demand destruction in services. We've seen it in China, we are seeing it in Japan, we are seeing it in Korea, and we are starting to see it in Europe. So I think it's very clear if you look around the world that this is a very sharp downturn. Again, it can be temporary, it can be relatively short because there's nothing wrong with the underlying health of balance sheets, particularly in the consumer sector. But I think this will only arrive in the hard data, particularly here in the US, in the next several weeks and months.
Mr. Fels, thank you very much for your time today. We appreciate your insight. Joachim Fels of PIMCO.
We're closely watching the yield on the 10-year note, which is back down around probably under 0.5% now because stocks are at session lows once again. You see the Dow down about 8.1%. There's a 10-year 0.505. This is one of the reasons the banks are getting hit so hard today. JP Morgan's down 10%. Citi, Goldman, Bank of America also lower. Look at Citi now, it's down 16%. Look at Bank of America, down 16%. Regional banks even worse, led by Comerica and Regions Financial. Of course, everyone trying to tease out the oil impact as well. Comerica down 21%. And the prospect of even lower mortgage rates from here isn't doing much to help the home builders today. Interestingly enough, this sector is deep in the red with KB down 13%, Toll down 7%, same for Pulte. We're going to take a closer look at this today and at the sector's future when we come back after this quick break right here on Power Lunch.
Some fiscal relief is given to the health workers, support to families. We know that there are many people that are uninsured from the health services, so we need to support and induce an additional element there to help the system to cope. Yes, it's uncertain, but countries are taking the measures that need to be taken, and therefore we will need to just track how markets start to report as this moves forward.
The Edge brings you the most exciting technology and groundbreaking innovation.
We expect to mass deploy them into hundreds of millions of devices.
From startups to the world's biggest businesses.
The opportunity to actually monetize the relationship with customers is going to be higher than it's ever been.
You, my friend, have gone from analog to digital.
We reveal the disruptors of the future.
This gives us the ability to charge 1,000 times faster than what you can do in lithium-ion batteries.
The Edge, only on CNBC.
Welcome, everyone, to the closing bell.
It's the most important hour of the trading day.
20 minutes to go before the close.
Do you think the volatility is going to stay with us?
When stocks move, when volume spikes.
The story that everybody on Wall Street was talking about.
Keeping you on the leading edge of what's driving the market.
Outlook for the sector is now not bad.
Minute by minute.
New highs on the usual suspects.
Wilfred Frost.
Positive territory again for all three of the indices.
Sarah Eisen.
There's the closing bell.
Closing bell. Weeknights on CNBC.
Live from the NASDAQ market site.
Access.
People talk about the presidency.
Power.
You went through the ringer.
Influence.
So what's the economy look like from where you sit?
The most powerful business show on the planet. Squawk Box. On CNBC. Opening bell action.
Global markets under some pressure this morning.
Financials are the best performers right now.
Is there a risk here? Look at these stocks.
Squawk on the Street. Weekdays.
Tessa Brewer, here's your CNBC News update this hour. The head of the World Health Organization is intensifying his warnings about the spread of coronavirus. He is also stressing the need for decisive early action to slow down and prevent further infections.
Now that the virus has a foothold in so many countries, the threat of a pandemic has become very real. But it would be the first pandemic in history that could be controlled.
Japan has begun asking travelers from China and South Korea to self-quarantine for 14 days to prevent the spread of coronavirus. Passengers from both countries are being asked to stay in their hotels or other designated locations and to avoid public transportation. Heathrow Airport is quiet today following flight cancellations to China, South Korea, Japan, parts of Europe, amid weaker demand for travel and by travel restrictions by many countries. That's your CNBC News update this hour. I'll send it back to you, Kelly.
Okay, Contessa, thank you. Stocks are right near session lows right now with the Dow down more than 2,000 points. There we are about 2058. That's an 8% drop. The S&P down 7.6%. The Nasdaq down just under 7% this afternoon. And you might think with rates plunging that the home builders would be up today, but no. Not only are they down, they're pretty much down with or more than the market. D.R. Horton down nearly 10%. KB down nearly 13%. Lennar down more than 10%, again, despite low interest rates and what has been high home buyer demand. The ETF, the XHB, is on pace for its worst day since 2011. And as we mentioned, the individual names in some cases down even worse than that. Joining us now to talk more about this is Jack Misenko. He's a home builder analyst at Susquehanna Financial Group. Jack, first of all, why are these stocks doing, in some cases, worse than the overall market today, when the one thing people say could be a help here is housing demand?
Yeah, I think part of the problem today is the issue of sentiment. Most people don't go out and buy a house because rates pull back. Most people, first-time buyers aren't sitting in their apartment saying, okay, now the mortgage rates are at 320, 325. Let's go buy a house. I think what people are pricing in is a fall off of confidence in the economy overall, potentially leading to some job loss at the corporate level. But underlying fundamentals for housing remain very strong.
Right. Is that fear rational to you? In other words, home builders have been a pretty strong performer. Would you go so far as to say to people, look, this sector can hang in there even if the economy slows?
Yeah, we would. In fact, we upgraded Pulte Group last week from neutral to positive. Think about the fundamentals of housing. You've got a supply imbalance. We've probably underbuilt just roofs, 500,000 to a million, depending on which numbers you use over the last 7 or 8 years. You've got the biggest demographic wave since the boomers coming into their peak home buying years over the next 6 to 8 years. And you've got record low interest rates. So, the fundamentals here are pretty solid. On top of that, you don't have a lot of supply chain issues, right? A lot of these, you don't have a lot of stuff being built or shipped in from China. It's a domestic play here in the U.S. So we like the fundamentals still. We've been in a lot of markets, even through the mid last week. We're hearing any signs of virus-related demand issues or anything of that nature.
So you're comfortable buying a lot of these stocks right now?
Yes, I think if you look at over a 3 to 6 month period, I think we're going to look back and feel like this was an overdone sell-off in the group.
3 to 6 months, let alone 3 to 6 years, right?
Oh yeah. I mean, you can't deny the fundamentals, and I think what people are looking at is if we're going into a recession, the knee-jerk reaction is, oh my gosh, the next recession is going to be like the last one. The housing, fundamentals in housing couldn't be more different than they were in, say, 07, 08, 09. It's a dramatically different environment. I think people have to step back and really look at where the drivers are today versus where they were. Mortgage credit is responsible. It's rational. People are, there's job growth, there's wage inflation. And again, we are undersupplied. I mean, the existing market is running about 3 months of supply. A normal market's 6. I think some of the builders this year have helped fill that void. And where you're seeing most of the strength is on that entry-level segment, those first-time buyers. The public builders are uniquely positioned to serve that demographic, more so than the existing market.
Jack, as we see KB the worst hit today, Lennar kind of secondarily so, are there any of these builders that have particular exposure to Texas, to the oil patch, to some parts of the country that may see a slowing because of the plunge in crude?
Sure, and we had a note on that just this morning. KB has about 11% of company deliveries last year from Houston, so they're one of the larger names in my coverage universe. I think that's partly what's driving the relative underperformance of the group. But you go back to 2014-15, we had a similar collapse in oil prices in the back half of 14. In 15, new home sales in Houston were only down 3%. So I think there's more resiliency in the Houston economy, but for today in the short term, I think people are singling out some of the builders like KB relative to others because of their, outsized, if you will, exposure to Houston. Other builders are in the 3 to 6% range of their business.
All right, Jack, thank you very much today. Jack Misenko on the builders.
Well, we've got a news alert on Amazon out with a new plan amid the spreading coronavirus. Deirdre Boza is in San Francisco. Hi, Deirdre.
Hey, that's right. A few new developments regarding its work-from-home policy. The company Amazon advising employees affected by coronavirus to stay at home until the end of the month now, till the end of March. Also encouraging more employees to work remotely, including those in New York and New Jersey. Those are 2 new states. And this comes in addition to employees that have been advised to work from home in the Seattle, Bellevue area, of course, where Amazon's headquarters are located, the Bay Area, and the Lombardy region of Italy. Now, guys, of course, this follows other big tech companies from Microsoft to Facebook advising employees to work from home. Back to you.
All right, thank you very much, Deirdre Boza in San Francisco for us. Stocks are off the session lows, but the Dow is still down not more than 2,000 now 1,900 points, but that's almost 7.5%. Brent Schutte is Chief Investment Strategist with Northwestern Mutual Wealth Management, and Sandeep Bhagat is Chief Investment Officer with Whittier Trust. Welcome to both of you. Brent, how How much farther does it feel like this market is going to go, or do you have a sense of it?
I don't know if you can have a sense for how far it may go, because I don't think probably the market bottoms until daily new cases peak, and that's the uncertainty, right? Like, who knows what the virus is going to do? I've heard a lot of medical experts who don't have an idea, it seems like. And so I guess the three things that I would focus on are that times like these are not the time to sell stocks. There is a lot of uncertainty, but history would show you that when you panic, when others panic, your intermediate to longer term returns are subpar. The VIX hit 59 this morning. If you go back in history, there are only 30 times I believe the VIX has closed above that, and each of them have given way to positive one-year returns. And so that may not be a call on the bottom, but I do think from a longer term, intermediate to longer term perspective, stocks are becoming better values at these levels.
Sandeep?
I agree completely with Brent. Clearly you favor stocks over bonds for the long term, and the damage has been done. The repricing has taken place. This is not going to be a contained event in China. We have a global contagion, and we have a price war in oil. The range of outcomes is so uncertain that, you know, everything is up in the air. We'll have a slow grinding recovery back higher, but you, at this point, you really just have to wait it out.
What if we have a recession?
If we come across one, it's likely to be one of the technical variety. It should be shallow in nature. The coronavirus was a one-time event. Pathogens do lose potency and they become less virulent. It should blow over, and then we'll be off to the races. And don't forget all the stimulus that will be put in place to fight this. We'll have a tailwind behind the market on the other side.
No, I get it. Since I'm putting a bullseye on my back, and I can't wait till 5 o'clock, but I can make an argument that the market's down 19%. You can make an argument that on a valuation basis, the market's exactly where we were 3 weeks ago, or more expensive, because nobody can tell me that earnings aren't going to be down anywhere from 20 to 25%. And the last couple of years, all we've seen is multiple expansion. So you explain that one to me, because it doesn't make a lot of sense. Quickly, JP Morgan, it's down more than the rest of them. Quickly, this is just my view. JP Morgan book value when they reported was $62 a share. Traded up to $140, and people say, you know what, they deserve that price to book valuation because they're the best bank. Now I think a lot of people saying, wait, you know what, JP Morgan is great, but now it's catching up to where the rest of the banks are. So I think the underperformance is them catching up in terms of price to book valuation.
So rational, logical. Let me actually pick up on that point, Brett, and ask you about earnings. You know, guys saying, look, if they fall 20 to 25% here, then all we've done is reset evaluations accordingly. Would you want to make a case for earnings being taking less of a hit than that, or taking more of one?
I don't know that anybody knows for certain, and so that's the real risk that's being priced into the market right now, is there is a lot of uncertainty. I guess I would take more of a look of what's actually happening in the economy right now. It's actually on pretty decent footing. I know I heard what Joachim Fells just mentioned, and I agree that the consumer is in great shape. And I can make the argument that the market is already pricing in a recession because we have fallen by 20%, which bear markets are almost always consistent with recessions. And so I don't know how much deeper it gets than this, but certainly I don't feel like we're in for another great financial crisis like we had in 08, 09, because the fundamentals are much different than they were then.
We began the hour, Brent, talking about whether, I don't mean to paraphrase, you can speak for yourself here, Guy, but I'll try and paraphrase that we are in the position we are in, the pickle we are in part because we've done it to ourselves with monetary policy. Do you agree with that? How much of where we are now is because the Fed has over time and repeatedly tried to protect us from the markets?
It's a great question. I don't know how you answer that. I guess I still see the Fed as a completely different organization than what they once were, and they're going to pull out all the different stops they can to keep us up and keep the economy afloat. I think you have more monetary stimulus coming. I have heard for 25 years of my career doing this, the Fed is pushing on a string. To my knowledge, they haven't yet actually seen the string bend. And so I do think there is a high likelihood that will have some impact on the economy. And I think more importantly, you're going to get more fiscal stimulus on the way that is targeted that will actually help bridge the gap between the coronavirus before and the coronavirus after. And so if we can do that, I do think that there is some cushion to the downturn in the economy.
Sandeep, I'm afraid the string just broke.
I know monetary policy feels like pushing on a string. It's been overextended. Its efficacy is diminishing. But let's talk about fiscal stimulus. People worried about the size of the debt. But with the long bond doing what it is, there is an insatiable demand for the 10 and the 30-year bond, which means there are more buyers. Why don't we supply bonds? Why does the government spend? And fiscal stimulus has a bigger multiplier effect than monetary policy. So I'm optimistic. You asked the question about where could earnings end up. Here's a quick back of the envelope calculation. Last year's earning 163, right now projected to be up about 7%. Probably overstated. Let's cut that down by 10%. So plus 7 becomes minus 3, 163 becomes 160. Next year we have an optimistic or conservative 8% rise. Once this blows over, you apply a multiple of 16 to those forward earnings, which is where the market has consistently found a floor. You're right at these levels of 2,700, 2,800.
What if earnings fall 20%?
Of course, then it's a different story. But the U.S. economy, last year's GDP 2.3, composite PMI at 55 suggesting 2.5, Atlanta Fed GDP now at 3.1% GDP, unemployment at 3.5.
Right.
The U.S. economy is really strong.
We'll leave it on that hopeful note. Sandeep, thank you. Sandeep Bhagat, Guy, thank you as well. Guy Adami, that does it for Power Lunch today.
And closing bell starts right now. You don't want to miss the next hour.
Welcome, everyone, to Closing Bell. I'm Sarah Eisen here on the floor of the New York Stock Exchange. A historic day on Wall Street. Stocks were halted earlier, just minutes after the open, after a 7% plunge. We are tracking for the worst point decline ever for the Dow. I'm down here at the Marathon Energy Post. That stock is down 47%. Oil prices, energy stocks are getting crushed. We're going to follow all of that for you, including the broader market meltdown. Hang on, everyone. This is the final hour of trade.
Good afternoon, I'm Wilfred Frost. Let's have a look at what's driving the action. The lack of a production cut deal from OPEC, coupled with a Saudi price cut, sending crude prices tumbling, the energy sector down 17% on the day alone. Coronavirus fears remain front and center as global cases top 111,000, and Italy locks down a quarter of its population. And the bond market chaos rages on as yields on the 10-year hit an all-time low of 0.31% and remain at the moment below 0.5%. Joining us for the full first hour of the show, Lindsay Bell from Ally Invest. They have $7.85 billion in total customer assets. She's here along with our team of reporters to break down this massive market sell-off. Bob Pisani's on the floor of the exchange. Brian Sullivan covering the oil price collapse. Mike Santoli is here to look at the market trends. Frank Holland on transports. We will get to all of our reporters. The Dow is down 7.25%. Bob, break it down for us.
Important thing is the circuit breakers hit this morning. First time really in a long time. Down 7%, halted for 15 minutes. Want to remind everybody that halt remains at 7% down. Now we have to drop 13% for it to halt again before 325. After that, it would not halt unless it dropped 20%. Then the market would halt for the entire day. Couple of major movers here. JP Morgan Chase was down 13%. That was this would be its worst decline since March 2009, since the height of the financial crisis. You see sitting down here. Bank of America also down about 15%. Certain sectors rallied and then just sort of drooped. Industrials, for example. Caterpillar rallied after the market reopened just before 10 a.m. And as you can see, sitting just off the lows for the day. Same with some of the other industrials like United Technology. There's only one Dow stock in the green today, at least most of the day, and that was Walmart. Surprisingly, Clorox also in the green, but not in the Dow. As you see that still remaining there in those grocery stores in general. Consumer names have fared much better in the overall markets. Guys, back to you.
Bob, thank you. Oil market collapsing as tensions between Saudi Arabia and Russia boil over, leading to massive declines for crude prices today and energy stocks. Brian Sullivan joining us here with more. Brian.
Yeah, Sarah, brutal day across the board. I mean, the price of oil down $10, about 23%. In fact, if you just kind of go back in time to reverse inflation to 1991, oil now is trading at about $17 a barrel in 1991 dollars. That's how far that we have fallen. That move, by the way, slamming an already slammed oil complex. You have names like Apache and others down 40 and 50% today. It is hitting all kinds of portfolios, pretty much the selling just across the board. And natural gas actually up a little bit. And I'm thinking the reason that is because the idea is that If we start to slow production, either organically, companies decide they're not going to produce more oil, or inorganically, they simply run out of money and go out of business, that we will also produce then less gas. Because remember, natural gas is a natural byproduct of drilling for oil. You already had a name like Diamondback Energy, the original FANG, come out and say it is slowing down crew completions, going to slow down well completions, guys. Everybody I talk to expects a lot more of that type of stuff. Remember, oil, not really an oil story. It's a job story, and it's a debt story. And we'll have more on the story, by the way, at 5 o'clock on Fast Money. Back to you.
Brian Sullivan, thank you so much for that. Now, bank stocks also getting absolutely slammed today. The strong correlation when panic is in the air with what yields are doing very much at play. Why? Of course, banks make a lot of money based on where the yield curve is. Here is exposure for the banks to net interest income. Citi, the highest, though Bank of America often seen as the most interest rate sensitive because of its high consumer exposure. And indeed, Bank of America was down 37% from its intraday February peak to its intraday trough today. Add to that the fears of exposure to the energy market that Brian was just talking about, and you have a perfect storm today for the banks. But here is loan exposure to energy for the big banks. Fairly low, though some small regionals will need to watch out for. Cadence, Bank 7 and BOK, some of the names with the highest exposure to energy, and accordingly, those stocks down sharply today. Indeed, unlike energy companies, bank stocks are still above their 2016 lows, which was the last time markets have feared a sort of rates are never going to rise again or oil prices are tanking type environment, and that might suggest more downside. On the flip side, they are a lot cheaper today on a relative terms, whether that's P's or P price to book ratios or dividend yields. Last week, Autonomous estimated bank stocks were pricing in a 50% chance of a recession. Clearly, that number today higher still. Here are their dividend yields, much higher than in 2016 at the lows, when the dividend yield for the group was about 2.5%. One other comparison that's being made is versus 2008. Two big differences. Capital liquidity so much stronger and higher today, and the epicenter of this crisis is not financial, and therefore clearly a big difference. Nonetheless, can expect more downside if yields or oil prices keep sliding.
Can you touch either of these groups, energy or banks, Lindsay?
I think you got to stay away right now. You got to let the dust settle here, and there's just so much uncertainty related to where yields are going. The market's pricing in a 75 basis point cut at the meeting next week after the emergency 50 basis point cut last week. With energy prices, it's a price war out there, and we don't know where it's going to stop. We know the $26 low on WTI in 2016. Will we go below that is the question.
All right, let's go over to Mike Santoli for a look at market trends in the S&P. What are you watching, Mike?
Yeah, Sarah, let's try to frame this. I mean, when you go down in price, you also go back in time. So take a look at a 3-year chart of the S&P 500. We were talking late last week about the chance that maybe the S&P had to retest the intraday lows from a week ago Friday. Those are around 28.55. We sliced right through, of course, simply because of that oil price trapdoor. So here we are. What I find interesting, before I get to where we go back to, 27.40 was a level people were looking for well before today. It was sort of the springtime low of last year. It's also some sort of technical retracement amount of the whole rally from 2018. But this brings us back, as I said, to early 2019. What I also find fascinating is these are levels that we first hit in January of 2018. So we're going back 26 months before, when we first got to these levels. So clearly a lot of stretching to the downside. We've got washout conditions across the market right now. We were oversold a little bit last week, now getting to be extreme oversold. I also want to get a longer term look. Today, we handicapped it last week as the 11th anniversary of the bear market bottom, March 9th of 2009. And so this shows you the entire length of it. What I find interesting, by the way, if we get to about 27.08, I think it is, 27.07, it's a 20% drop. We close there. We can finally say, at least on a technical, statistical basis, it's over. But I think, so I told you we went back to 2018 right there. Look at the previous times we've done something like that, where you've kind of gone back about a year and a half or so to where we first got to these levels. So it's not that unusual. What is unusual is how fast we plunged, we surged above it, and then gave it all up right now. So clearly, it's still a treacherous situation, just looking at a lot of the intermarket stuff, the volatility indexes, and the credit markets.
Mike, it seemed earlier in the session like the circuit breaker helped, because after we reopened, we were more like 4 or 5% down on the day. now testing the 7% level again. What do you make of whether they helped or hindered or what?
It's interesting because the index futures, as we know, pre-market, they're limited to a 5% loss. The ETFs, based on the indexes, were indicating a 6% or so loss. My read on that was, if you're down 6.25 on the ETFs, you're testing that circuit breaker. There's almost no way you're not going to touch it because you're so close to it. Then once we did, we had a lot of purging of stocks on the open. A Monday open, you have a lot of Mondays where you have down 3 or 5% days. It's the most frequent day to have a big loss. And to me, you've got a lot of it out of the way. And I think the fact we were down 12% coming into today is part of that reason. Also, yields did actually bottom overnight.
What is it about Mondays?
You have all weekend to think about it, I think.
So, Lindsay, I mean, what stands out is the speed at which we have erased just what, almost 2 years of a rally?
Mm-hmm. Yeah.
What does that tell you, how fast it's happened?
Well, the speed is definitely breathtaking for sure, but it also means that we can bounce back much quicker too. What we have historically seen is it takes normally about 5 months to get to correction territory, and then you get five months later, you're back to where you were.
This was what, 2 weeks?
Yeah. So I think that we can potentially see it happen much quicker, but there's no guarantees.
Transports plunging today along with the broader market. Frank Holland has more on the action in that group at the NASDAQ today. Frank.
Hey there, Sarah. You know, Dow Transport's on pace to close at their lowest level since December of 2008. Rail stocks especially plunging as this week investors expect to see the impact of lower container ships and overall imports from China, which would, of course, directly hurt rail volumes. J.B. Hunt, the largest container trucker in the U.S., those shares down right around 8%. It gets more than half of its revenue from hauling containers. Airline stocks, they continue to be under pressure from reduced business and leisure travel. United and American have both lost about half their value since the first U.S. coronavirus case. Delta and JetBlue right around a third. And the major shippers also getting hit today with the broader market. UPS, it gets about 4% of revenue in China and already gave lower Q1 guidance due to coronavirus slowdowns. FedEx gets more than 4% of revenue in China, according to Deutsche Bank estimates. It reports earnings next week that will certainly be a window into the health of the U.S. and the global economy. Back over to you.
Okay, Frank, thanks so much for that. Now, oil prices seeing their biggest one-day decline since the start of the Gulf War on January the 17th, 1991. Oil lost 33%. How far will oil prices drop from where they already are? Joining us, Ed Morse, Citi's Global Head of Commodities Research, and Paul Sankey, Mizuho Managing Director and Oil Analyst. Very good afternoon to you both. Thanks for joining us. Ed, I'll start with you. I mean, extraordinary moves in the oil market. We're currently down 25% on WTI. How much of a sort of perfect storm is this for oil prices at the moment, or can it still get worse?
I think it can get worse. What makes it a perfect storm is that this is the first real crisis in which we've had a demand shock on the one hand and a oversupply injected in the market for political reasons by major producers. So we've never seen that before as a coinciding set of factors. But yes, there's much more downside risk at the moment.
How do you gauge that? Why?
So you look at where demand is going, and then you compare it to where the supply is coming from, and you look at the indicators of where inventory is going to grow. You know, we think now that negative growth territory is where we are for the world economy as a whole. We're going to see negative oil demand growth. That number is an open-ended number. We're pretty sure it's going to be negative year on year, but we don't know how far negative. Let's assume that we have something in the U.S. and Europe that is similar to what we have in Korea, Italy, and China. We had a big hit, 70%, maybe even 80% at the peak in February of Chinese transportation fuel demand was lost. If we put that same number into the OECD economies, that could be a 12 million barrel a day loss for as much as a month. We don't have that figured into balances. If the market sees that the Saudis and the Russians are continuing to produce a lot more, and there's another demand shock on top of the current one, that's another big step lower in terms of prices.
So, Paul, I mean, it is brutal out there if you're an energy company. Marathon Oil right now down 47%. Apache down 46%. This is one-day moves. What's going to happen to these companies?
Well, it's going to be very hard for everyone. As Ed says, we don't really know where we're going, and it just becomes a question of how good their credit is coming into this and how much access to capital they have. And the second thing, which we've been pushing for 2 years now, is they all have to aggressively cut CapEx. So what we're looking for is the fastest to cut and who cuts the most. And we'd like to see Exxon leading the way there, but we've already had announcements today, for example, from Diamondback, Fang, Parsley. The fastest, best movers are already saying, okay, we're cutting.
Who's in the worst financial shape?
The two bellwethers amongst the high yield would be Chesapeake, that's trading the most today, and amongst the investment grade would be Oxy, are both really the bellwethers that we're looking at the credit for. The other challenge here, as you know, is that everything is traded by machines these days, so active managers are just on the sidelines, and we're just letting the machines do their thing, which is why you get these extreme moves, because there's no guy standing there with a piece of pen and a paper that used to be to control the market.
And whether it's machines or individuals, it's quite hard to price a binary outcome risk like a company actually going bust. What percentage chance, let's pick the two you just said, Chesapeake and Oxy, what percentage chance do you put that they go under? Is it a 1% risk or is it a 20% risk?
Oh, I think in the case of Chesapeake, it's an extreme danger, frankly. I mean, I don't
More
think
than
that's
50%?
a surprise. Yeah, I mean, I think I've got to be careful what I say because I don't cover the stock and I wouldn't want to, get ahead of myself there, but it's certainly pricing extreme risk. It has scale still, Chesapeake, in terms of market cap. It's still over $1 billion, I think. Maybe not today, but was as of last week. So that's why it trades as very much as the bellwether. But you can see that the debt is trading at pennies in the dollar right now.
On the flip side, BP, a major company with a pretty strong balance sheet, was down 20% today. I mean, is there any chance that that company goes bust?
No, I don't think so. I mean, I think the very biggest here, these global super majors that have been around. For 100 years are going to come through this. I don't think there's any question about that. But they are in a competition, as Ed has referenced, with the Saudi balance sheet and the Russian balance sheet. That's really where you're at. So where we think the market balances, given what Ed's saying about demand, is US E&P and capex cuts and balance sheets. That's going to be the deciding factor. And we're going to have to cut US production by as much as the market needs to balance, which is just going to be a lower and lower price and worse balance sheet.
So, Ed, I mean, some of the chatter is Putin wants to put the U.S. fracking business underwater. I mean, is that really what's going on here? Let's talk a little bit about the political dynamic between Saudi Arabia and Russia and how the U.S. oil industry gets dragged in.
So there's no question but that the Russian companies would like to put the U.S. shale industry under. So we have to separate out. I don't know what Mr. Putin is thinking, but we've had the CEO of Rosneft make a series of comments from the middle of last summer to today saying, we don't have to worry about Saudi Arabia. We're losing market share. We need our market share back. The real elephant in the room is the U.S., and there's nobody at the table in the U.S. The U.S. can't have a political leader at the table because of the nature of the U.S. industry, so it has to be driven down by price. Now, others have tried this before. The Saudis tried it in 2016 and 2014, as early as then, and they cried out uncle, and we'll see what happens on the Russian side.
How much ammunition or how much time do the Saudis have? Can they maintain this price war?
Yeah, so they're both sitting on war chests. The Saudi war chest is about $500 billion in cash available. They were sitting on that same amount, maybe a little bit bigger in 2016 when they and the Russians got together. The Russians have built up a war chest, and they are much less vulnerable for several reasons. One is the world has cut Russia off from the rest of the world economy, so their liabilities in terms of hard currency are lower than Saudi liabilities in hard currency. But the real significant difference is the Saudi currency is pegged to the U.S. dollar. As prices go up in U.S. currency, their revenue goes up. As prices go down, their revenue goes down. The ruble actually floats, and it appreciates with oil prices. It depreciates with oil prices. That correlation gives it a kind of a boost when the ruble is low and prices are low and the cost of production is lower, and the chances of a company in a ruble-denominated cost environment expanding in that environment is much greater. So I'd say, they're both going to struggle at $30 or lower for a prolonged period of time, but in the short run, the Russians are sitting more comfortably.
Would you buy any of your companies right now, Paul?
I think that we like the best. So, an EOG or, particularly EOG, some of the very best stuff is very attractive right here. Absolutely. Yeah. One thing I'd add to what Ed's saying as well is we haven't heard the last from the president here. I mean, we could put in an import tariff. For example, they could stop releasing SPR and stop building SPR. There's a number of things that we might see if things get bad enough from the U.S.
Well, so far he's tweeted it's good for American consumers.
That was today. We'll see what happens.
Paul, thank you. Paul Sankey, Ed Morse. Good to see you both. CME Group Chairman and CEO Terry Duffy joins us now in a first on CNBC interview. Terry, good to have you, especially on a day like today. Welcome.
Thanks, Sarah. Appreciate it.
So tell us from your vantage point what you're seeing in terms of how the market is functioning after these giant moves across assets.
Well, I think there's a whole lot to talk about. I mean, you've had a lot of guests on today with a lot of different opinions, but you know, the markets for the most part are functioning quite well, even though they're going in high, the volatility is quite high. We are still seeing a tremendous amount of trade and people being able to do their risk management. When you know, I think one of the real issues that you're seeing, Sarah, here is, this reminds me a lot after the 08 crisis when we were going to get into new regulation, except nobody knew what that regulation was going to be. So what we're seeing now is complete unclarity as it relates to the marketplace. No one knows exactly what's going on as it relates to the virus. So if you want to get some stabilization to the marketplace, I think we need to get the test kits out into the hands of the public. We got 75,000 test kits today. And, you know, for the most advanced country in the world, we're not doing that. So you can't have 500 cases reported here in the United States and 16 million quarantined in Italy and saying they're both correct. Something's wrong here. And the markets, they know that. And the markets are trying to figure out some clarity. So whatever it is, I would be hopeful that our government, instead of trying to slash the rates to zero, would get these test kits out into the public domain so we can figure out exactly what it is, and that will help the overall market in general, knowing exactly what it is.
And Terry, how are markets functioning? I mean, not just the last couple of weeks, but particularly the last 24 hours. Clearly, extraordinary news flow over the weekend when there's not much liquidity in various different futures markets. How have things functioned in the last day or so?
Yeah, they're functioning just fine, and there's liquidity. I mean, I've heard some of your earlier guests today saying that there's not enough liquidity in the marketplace. Well, you know, the bid offer is going to get wider in this high volatility. I don't care what you're trading. It doesn't matter anything. But, you know, we're still trading just under $1 trillion of notional of E-mini S&Ps every single day. So there is plenty of liquidity. It's just at a different price levels than it historically is when you don't have the volatility. So the markets are functioning properly. The circuit breakers kicked in, as we talked about earlier. The oil's been a big story. As you know, the input cost for U.S. producers is between $40 and $50 a barrel. I mean, the Permian is the cheapest at $40. You know, your earlier guest was talking about this. When you look at oil in Saudi Arabia, their input costs are between $20 and maybe as low as $12. So it doesn't mean it's going there, but their threshold for pain is a lot greater than ours. And that's why it's important for people to use markets like ours in order to defer some of the risks.
Wanted to talk about the impact of trading halts. I mean, you guys halted futures, right, last night when we saw the 5% decline. What is the impact of that? How does that help or hurt the process, especially when you have the rise of algorithmic trading?
Well, here, and that's another thing. Everybody wants speed for everything they do in life, but they don't want to have it in markets. So we want to make sure that markets go nice and slow for us, as we want our computers to be able to, you know, search anything in a nanosecond. So that's not the world we live in, sir. So algorithmic trading is not the issue. The markets move quicker like everything else in life. They're efficient. You know, we were down to 7% this morning on the halt. That's really where we halted, was this morning, and just in coordination with the other marketplaces. So again, I think they're a good thing. I think it gives people an opportunity to reassess what's going on. You saw the circuit breakers kick in this morning, and actually you had a little bit of an uptick. I think, you know, I'm not going to predict the markets, but I do know one thing. Markets hate uncertainty, and that's exactly what we have right now. So I would hope that our administration would get these test kits out to the public, and everybody that does not have an MD after the name, stop saying wash your hands and call your doctor. You can't even get a hold of your broker, let alone your doctor. I mean, we need to make sure we know exactly what we're dealing with here.
Terry, gauge for us with the amazing experience you have, what level of fear you feel is out there at the moment in the marketplace. We hit the circuit breaker, oil's down 25%, the VIX is above 50. Do you have any sense that you feel like fear has peaked or is peaking?
I don't know if it's peaked or peaked. I think there's uncertainty, and that has not peaked yet. And that's my whole concern that I have, Wilfred, and this uncertainty could be alleviated. I mean, I don't want to see the numbers go up. No one does. But if they're up, we should at least know about it, and then we can at least assess what we're dealing with. But we can't assess what we're dealing with. So it's really hard to say that, you know, the uncertainty in the marketplace, or the fear factor, for lack of a better term, is at its peak, or it's going to sell off from this point or go up from this point.
Really quickly, Terry, just when you do have the market halted, is there any concern about ETFs still trading when the underlying security, that is the index, is halted? I mean, this also feels like we're in kind of an experimental regime with the rise of ETFs and the fact that there's been so much money in them.
Well, you're absolutely right, Sarah. These ETFs are just started trading in overnight hours just as of recently, not that long ago. I mean, a lot of them are completely illiquid. There's some that are liquid. So, again, we don't list ETFs here at CME. So, you know, we're very focused on our index businesses and making sure that we can manage the risk. So I really don't want to comment too much on the ETFs other than, you know as well as I do, there are many of them that are just as illiquid as those that are liquid.
Yeah, this is going to be a test. Terry Duffy, thank you.
Thanks, Sarah.
Now to an update on coronavirus numbers and the big impact the outbreak is having on one industry in particular. Meg Terrell with the latest on the spread, and Seema Modi is watching the cruise companies. Meg, though, first to you.
Well, hi, Sarah. The numbers are now topping 113,000 around the globe with almost 4,000 deaths. The World Health Organization today saying the threat of a pandemic has become very real, but that it would be the pandemic in history that could be controlled. Director General Dr. Tedros saying, quote, "We're not at the mercy of this virus," emphasizing the actions taken by governments, businesses, communities, and individuals can make a difference. He also pointed out that of the 80,000 reported cases in China, more than 70% have recovered. In the U.S., the CDC warning today that it's likely many will be exposed to the virus this year or next year, and that there's a good chance many will become sick. Dr. Nancy Messonnier emphasizing the risk of more severe disease rises with age and underlying health conditions. Total cases in the U.S. now topping 600. Guys.
Meg, thanks so much for that. Mike, clearly over the weekend, the news flow, even putting oil aside, the news flows that related to the virus kind of much worse than what the market was sort of expecting with the news to quarantine Italy.
Perhaps, yes. I mean, I think that's the interplay that we're watching now is the market kind of in a preliminary way trying to rush to a place that tries to build in a lot of these risks and then seeing if you can absorb the headlines when they come. I do think that's fair to say it was a little bit worse than expected, but right now I wonder if we're getting to that point where we've just been living with it for 3 weeks right now, and everyone, at least intellectually, assumes there's going to be higher numbers. So today, to me, was mostly about the destabilizing effect of oil and then the spillover into credit, which was an exacerbating factor on what we already knew we were contending with.
One sector, of course, that has been slammed throughout this last couple of weeks has been cruise operators, and today, no different. The State Department issuing a warning to all Americans, and this hour, the Grand Princess cruise ship, which has been stranded off the coast of California amid a coronavirus outbreak, is heading into port in Oakland. Let's get to Seema Modi for the latest. Seema.
Wilfred, U.S. State Department warning Americans with underlying health conditions to not travel by cruise ship as a number of coronavirus cases continue to rise. That's sending cruise stocks down as much as 20% just today. All three cruise lines are averaging a year-to-date loss of around 60%. Investors now taking a close look at the financial positioning of these cruise lines by examining their debt-to-equity ratios, which above 100% for Royal Caribbean, about 135% for a Norwegian cruise line. Today, Norwegian actually entered into a revolving credit facility with JP Morgan Chase of around $675 million to provide additional liquidity to that company. Analysts also warning Carnival's dividend of 8 to 9% may be hard to maintain at these levels if bookings drop sharply and costs around quarantines continue to rise. We are watching that Grand Princess ship approach the dock in Port Oakland with more than 3,500 passengers and crew on the ship from 54 countries. Guys, back to you.
And Seema, you've been talking us through some of the policies if you want to cancel your cruise. Just remind us, how long do you have to rebook it? Do you get a credit? I mean, what happens to that lost business?
So, Sarah, it really depends on the cruise line. For Carnival and Royal, you can cancel 48 hours before the date of your sailing, but they don't guarantee a full refund. In many cases, they offer you a credit which can then be applied to a new cruise or a future cruise. So that's really how it works. You really have to spend time calling the company if you are looking for a direct refund.
Seema Modi, thank you so much for that. Now, if you're just joining us, we're seeing a massive sell-off here on Wall Street. The Dow and S&P seeing their biggest losses since August 2011. The broader indices at the moment, the Dow is down 6.5%. That is off the lows. We're down 1,700 points. The low was down 2,100 points. Nonetheless, of course, an extraordinarily large decline. There is the Dow 30 stocks, as you can see. Right at the bottom, you've got Dow down 20% plus, and a number of companies down double digits, like Boeing, Caterpillar, and JP Morgan. One stock holding on to slight gains, and that is Walmart, up 0.9%. Still to come, TD Ameritrade Chief Strategist JJ Kinahan will join us at Post 9 to talk about what kind of trading volume the company is seeing, and in particular, what clients are wanting to sell and buy.
Number of key notes out from sell side this morning to tell you about. Bank of America saying stocks have not been this attractive compared to bonds since the 1950s on a dividend yield basis, and reiterated its bullish stance on tech and healthcare. However, not everyone is looking for bright spots in the stock market just yet. JP Morgan, for instance, saying a sustained buying opportunity not likely to come for some time. The firm suggests investors keep selling into any strength and reducing their positioning in stocks. UBS also predicting the sell-off is not finished yet. That firm pointing to key market dynamics, keeping them cautious, like elevated risk pricing in defensive assets like gold and the 10-year Treasury. And Moody's chief economist Mark Zandi joined us earlier on CNBC today and was asked about the odds of recession.
I'd say 60, 65%. I think it's going to be very difficult to avoid a downturn. How deep, how severe, it really depends on the administration and Congress. I mean, the Fed is going to cut rates to zero, and then the onus will quickly shift to the president and the Congress to come up with a fiscal stimulus package.
Lindsay, where are you guys on your call for the market and whether it's linked to a coming recession?
Yeah, I mean, the news out of the energy complex really does add an element to the situation that we're in right now that increases the risk, okay? Energy is 8% of the economy. It's a smaller portion of the S&P 500
right?
index.
More like 3.
More like 3, yeah.
Hit so hard, yeah.
Yeah, so it's much less of the index, but it still is a big part of the economy, and you have to think about all the industrial companies also that feed into that industry. So look, I looked back at 2015, 2016. We came from a position of strength going into that. That was an energy-led economic slowdown. There was a slowdown in investment spend and CapEx as well. And we came from GDP rates of 3%, and it was cut basically in half in the third and fourth quarter of 2015. So that could potentially be something like what we see from a GDP perspective. This year, we're coming from a little bit weaker stance. But then on top of that, you have to throw the coronavirus impact and what that does to economic growth in the travel, leisure, and entertainment areas too, which are much smaller. But so I'm more worried about the energy complex.
Mike, do you feel like the market is priced in a recession now, or are we not quite there yet?
I would say not fully, no. I mean, you've kind of started at a very high valuation level, relatively speaking. I do think there are parts of the market, however, that have gone a far distance toward pricing in a pretty bad run for earnings in the economy. If you look at the cyclical areas, there's something like 150 S&P 500 stocks that are down at least 30% from their high. I mean, it's not as if everything was going up until 3 weeks ago and they've all come down 18% like the S&P has. So I think we're getting there. I don't think we've generated absolute value, but to the B of A point about dividend yields, you have to figure out how to interpret this new world of ultra low treasury yields, because for the entire history of markets until the late 1950s, dividend yields were always higher than treasury yields and than risk-free bond yields. Then they went down for 60 years. They went below, and I think we're probably flipping the switch again unless treasury yields come up
So
quickly.
you don't buy the fact that
I don't think
stocks
that in
are buy
itself.
because dividends pay higher yields than treasury.
I don't think that in itself, certainly not tactically. Maybe longer term, they're going to be privileged if you have steady dividends, because there's just only so much yield in the world. They will get supported on a valuation basis, but I don't think that that's your buy trigger simply because we've crossed that threshold.
But also, Mike, how many limits are there out there that bond investors aren't going to be able to take their profits and shift it into dividend yielding stocks per se? It's not as simple a switch as, oh, this stock's up, this stock's down, I'm readjusting my portfolio.
Right. I don't think it's necessarily a flow from one into the other. It's just the incremental marginal dollar. Does it go more likely to dividends, dividend-paying stocks versus risk-free bonds? That's the question.
We have got just under 30 minutes, 27 minutes left of the session. Here's a look at the major averages. We are down 7% on the Dow, just shy of that on the S&P, down 6.3% on the NASDAQ, and 8.7% on the Russell. These are single-day moves. Extraordinary. Bob Pisani's here on the floor of the stock exchange looking at all the biggest movers. But Frank Holland, first of all, having a look at the biggest sellers on the NASDAQ. Frank.
Hey there. Well, the NASDAQ trading below 6% lower and on pace for its worst decline since August of 2011 when the U.S. debt downgrade happened. Only 2 stocks in the NASDAQ 100 trading in the green. That's O'Reilly Auto Parts and Dollar Tree, both with strong U.S. retail domestic networks. On the other side of things, tech and transports, both of those trading lower. Tesla trading 12% lower, definitely facing a headwind from lower U.S. gas prices for that automaker. Chip stocks falling dramatically as well. Western Digital falling by 11%. Micron down by 9%. FANG stocks also trading lower as we get into the close. Apple having the biggest negative impact on the NASDAQ 100 after reports that it sold dramatically fewer iPhones in China as this coronavirus outbreak continues. Now over to Bob Pisani at the New York Stock Exchange.
And Frank, we had JP Morgan, one of its worst days since the financial crisis. But this is a day for circuit breakers. A wild first hour. Been quiet really since the first hour. But I want to show you Halliburton as an example of what circuit breakers can do. Look at this stock. We had a halt at 933. That was the first one. That was the S&P 500 halted, as well as Halliburton. But then Halliburton was halted again on an individual circuit breaker just for Halliburton. 10 o'clock Eastern time for 5 minutes. And then a third time at 10:22. Another individual circuit breaker halt for another 5 minutes. So 3 trading halts in 1 hour. Haven't seen that. I don't remember when. And you can see Halliburton down about 37%. I've been asked a lot about gold stocks today. What's going on with gold stocks being down so notably? But wait a minute. Gold's up. And this is because gold stocks act like stocks sometimes. And we have concerns about slower global demand for gold potentially out there if the global economy slows down. And of course, you've got some people out there saying the gold miners would suffer because of that. Guys, back to you.
All right, Bob, thank you. Just want to give you a check of the S&P sector heat map. Every sector is lower in this broad and sharp sell-off here on Wall Street. Energy is by far the worst hit, down 18% at the bottom of the pack after crude oil is almost 25% plunged. Financials, second worst performers, very much tied to the energy story and the low yield story. That group down 10.6%. The ones doing the best, consumer staples, healthcare and communication services, they're all down at least 4%, which gives you a sense of the size and the scale of the selling that is going on. I think there are 10 stocks in the S&P 500 that are actually positive as it stands. Less than half an hour to go before the close. 3 things driving the action right now. The lack of a production cut deal from OPEC coupled with the Saudi price cut, sending crude prices tumbling. That energy sector, as I mentioned, down 18% on the day, with some individual names down 40 to 50% or even more. Coronavirus fears remain front and center for investors as global cases top 111,000, with at least 607 cases in the United States. And the bond market chaos rages on as the yield on the 10-year hits an all-time low of 0.31%. We are meaningfully above that level, but boy, was that crazy to watch overnight.
We were still below 0.5% though, which in itself is quite extraordinary. We've got 24 minutes after the session. Let's get to Mike at the Telestrader with the next installment of the Dashboard. Mike.
Yeah, well, so many ways to try and capture the anxiety levels of the market. Here's one of them. It's the ratio of gold prices per ounce to WTI crude oil per barrel, right? Goes back 20 years. Now, there's no intrinsic relationship here. It's not as if we know what this should trade at, but what I do find interesting is how it goes vertical and spikes at certain moments. So this obviously is pretty close to the bottom of the great financial crisis. Here you had that early 2016 run, oil collapsing, gold going up. So I don't want to say it's the ratio of useless commodities to useful ones, but it does show you when people are very, very worried about big picture stuff in the world, buying a lot of gold, and also very despondent about the likelihood for the global economy doing better down the road. So right here, you see a higher high in this ratio. Not going to say it's a timing mechanism, but it's going to fit alongside a lot of other things that are saying maybe we have the ingredients for some kind of short-term peak in panic coming up, guys.
Mike, I guess today, though, and indeed more broadly over the last couple of months, it's been very much the oil side that has had much bigger moves.
It has. Now, gold did trade up to a high, but you're right. It's been more violent on the oil side. That's been the leg that has shot this ratio higher.
Do you see this as a recession tell or just a sentiment gauge?
Well, I think it's more of a sentiment gauge, too. And I think, there's the numerator and the numerator and the denominator are two very different things. And so they can move very quickly, like Wilf pointed out. I think right now it's really being driven by oil prices. sharply dropping.
Gold sort of being flat today, you could argue, is one of the few things out there that suggests fear isn't as broad as perhaps it could be.
And
or that they're selling everything.
Or that
yeah, I was just going to say they're taking profits. So
let's have a look at the S&P 500 heat map very quickly with just 22 minutes left of the session. Wow, just a handful of stocks there in the green at the top. So many stocks in the red. The broader S&P 500 down 6.2%. It's off the lows. We were down more than 8% at the low. The Dow's on pace for its biggest point decline in history. Joining us for more, JJ Kinahan, Chief Market Strategist at TD Ameritrade, and David Balin, Chief Investment Officer at Citi Private Bank. A very good afternoon to you both. JJ, I'll start with you. How fearful have clients kind of been over the last couple of weeks and today?
Well, you know, it is interesting. Our trading has picked up pretty significantly as we head into March. But overall, I think our clients have been, if you look at our IMX, which came out today, they've taken less exposure to the market, but certainly not to panic mode. They're down about 9% this month in terms of overall exposure to the market from last month. They started to buy fixed income toward the end of last month as coronavirus picked up more in Asia, et cetera. But, you know, talking to the folks on our phones, et cetera, it has not been a sense of panic. And I think the market overall, the first sense of panic I really saw was last night in the overnight future session. Over than that, it's been an incredibly orderly sell-off.
where are they cutting exposure? What kind of names?
Amazon, Netflix, which both hit 52-week highs last month, so I'm okay. Twitter, Square, those names, obviously, with Mr. Dorsey being involved in, you know, a lot of things. I know the news came out this morning. Activision, you know, those are the types of names they're getting out of, Sarah. And where they're heading for is names that are well-capitalized, kind of, I call more traditional names. Apple, Microsoft, Disney, paying some sort of dividend. You know, I think people want names that have sort of stood the test of time a little bit more right now.
Mike, does that suggest, it's a small sample, but not suggesting you've only got a small number of clients. But Mike, there's still another wave of selling to come if retail investors haven't taken part yet, or are we just trying to find?
It's tough to extrapolate just from that. I mean, I do think you can say that perhaps this hasn't gone on long enough for there to be a kind of full wholesale give-up type trade among retail investors. But there have been pretty heavy outflows from things like ETFs, and the survey stuff is mixed at this point. But I do think time has been the missing element.
David Balin focusing on Citi's private bank, so I guess some more high net worth individuals. What have your clients been doing, and what have you been telling them?
Yeah, I mean, they've added to their gold and their treasury positions in February, and now we're seeing them begin to move back into the market in certain of the areas. We saw that first in Asia, where a lot of those clients have been buying their local markets. We saw today they're actually buying U.S. markets. I think that this is a particularly severe sell-off relative to what's really going on in the core economy. We've advised them, you know, that once markets get down about 20%, that becomes an attractive entry point, generally speaking. And in some ways, these externalities, right, which is you have a coronavirus situation which could last 2 to 4 months. It's very significant health, economic, and social issues. But when you look at the core economy going into the crisis, the health crisis, you can see just how strong it was in general. And we had expected an up year in earnings in the United States of about 7%. So even though we've revised that down, we see clients are much more interested in understanding, is this going into a recessionary period now into 2021? Or do we actually see this as a exogenous shock that's going to last for a reasonably short period of time of 3 to 4 months? And that really is our primary view right now. Our clients are actually, as I said, buying into equities, into different sectors of the market right at this time.
We're looking at an S&P down 6.4%. David and JJ, stay with us if you would. We are getting some new comments coming in from billionaire investor David Tepper. Steve Leisman has that for headquarters, at headquarters. Steve?
Sarah, thanks. I did have a conversation with David Tepper about how credit markets are functioning. He did not seem overly concerned is the overall impression I'll give you. He said he is not surprised that in some market bid-ask spreads have widened, given how much volatility. He said you have to have that in order for people to make money in there. He said it's a risk management problem, not a liquidity problem, by which he means there's players out there reducing their risk exposure, even though there may be sufficient amounts of liquidity out there. He said there's liquidity in markets, but not for all contract sizes. Some of them it has dried up, but mostly he is able to make the sales and the buys that he wants to make. And again, he just scoffed at the idea there's anything like the financial crisis. He says there is now much less leverage in the banks. And one other thing, adding to liquidity issues, he says the desks themselves are split up. because of the coronavirus. He says some people are here, some people are there. He thinks the situation on the desk will improve when they're back together. And I can add to that personally, Sarah. I called a repo desk this morning to see how credit markets were trading. And the guy said, well, I can't really tell you too much because I got one guy at home and I'm here, so we call back later, is what he told me.
Well, that's pretty interesting, Steve, just to follow up on that. I mean, I've spoken to all of the banks over the weekend, and my gauge of it is roughly 10% or so of the headcount they're taking off-site into their backup locations. But I'm surprised if there's a feeling out there that has stopped the proper functioning of markets. I mean, clearly, either way, Mr. Tepper's conclusion was there's plenty of liquidity and markets are functioning well.
Yeah, I think that's the important part. I guess it depends on who that 10% is, Will.
It does also, though, highlight an issue that if this does get a lot worse in terms of the need for quarantine for banks, that it would be hard for the trading floors to function with everyone having to go home. That's why it's so important to have these backup sites.
You have to believe there's a reason people go through the pain of getting on the train to the subway, to go into the office, to get on the desk. There's some rationale for that. Otherwise, we'd all be doing it at home anyway. And so you have to believe there's some informational or process reason why they do that, and that there's some diminution in that functional process there when they stay at home. And that's what I heard this morning. I wasn't able to get a clear read from one desk. Tepper says he's hearing it from other people out there that there's some problems in functioning of some of the desks because they are spread out. So, and he thinks that's a temporary problem. Overall, he thought some of these issues out there were pretty temporary. He did not seem overly concerned of the critical issue, as you point out, Wilf, of the functioning of the markets. Things can fall, but they seem to be falling, at least in a reasonably orderly way for most markets.
Any sense of whether he's buying or selling?
Actually, to prove something to me, he actually bought, well, he went through the process of buying a contract on the phone with me to prove how there was certain liquidity out there. But I don't know overall his book, and I didn't ask him.
All right, Steve, thank you.
Thanks.
Steve Leisman. I mean, again, another, I would say, positive read, right, JJ, that the market is functioning well, there's liquidity. It's not the kind of crisis-style, panicky reasons that we get.
Absolutely, and the markets have performed very well. I mean, you know, sometimes people criticize market structure. Overall, I mean, I'll look again, it's a sample size, but it's our sample size. In January, we averaged 1.48 million trades a day. We are now March to date, we're averaging 2.3 million trades per day. Everything's functioning as it should, and it's been, in my eyes,
so
really...
So then you have to wonder what a 6% down day is actually trying to tell us. I mean, is that a fundamental story?
Well, it's just that we saw, you know, we're just seeing corrections over time. It's the old adage, you know, the market goes up the stairs, jumps out the window when it goes down. It's jumped out the window even more so than most days, I think. The bond market's been kind of warning us over the last few weeks. And I think the biggest issue, Sarah, is if you look at like tariffs last year, there were dates people set. You know, if this doesn't happen on this date, we'll do something. With the coronavirus, there's no date, and that's tougher for people to get their arms around overall.
JJ Kinahan, David Balin, thank you both very much for joining us. We've got 14 minutes left of the session. We're down 6.5% on the S&P 500. Time for the last chance trade. Lindsay, what are you going for?
Well, I think when you look at the market for opportunities, what you really need to take into consideration is the environment that you're operating in. And right now, that's an extremely volatile environment. It's one that there's a lack of direction and clarity with regards to economic data and earnings forecasts. And for that reason, I started looking at GLD. I know Mike talked about how there are some different indicators where maybe it's starting to become a little more overvalued. But when I think about gold, this yellow metal, it really benefits from central bank activity. And that's when monetary policy is easy and going to continue to ease. Also, when there's an expectation for fiscal stimulus to increase, gold usually does well. And when we have this amount of uncertainty, you've heard many guests come on your air all day today talk about they don't know where the economic environment is. Gold has historically been a very good store of value, and it usually outperforms in a down market. So for that reason, I took a look at GLD.
It is odd to see that it's flat on a day the market is down 1,700 points.
Well, you know what? The same thing happened last week. It declined, or 2 weeks ago, it declined 5% and then popped 7%. So I think that you just see some investors really taking profits here if it's to make margin calls or just really take money off the table and put it somewhere else that has come down significantly.
Going into yen, Swiss franc, some other favorite safe havens. Coming up, we're going to have much more on the sell-off and how investors can protect their portfolio when we are joined by Mad Money's Jim Cramer. Looking forward to that.
We've got 12 minutes left of the trading session. We're now in the closing bell market zone. Commercial-free coverage of all of the action going into the close.
Today we've got Ally Invest Lindsay Bell, CNBC Senior Markets Commentator Mike Santoli, and Cantor Fitzgerald's Global Chief Market Strategist Peter Cecchini here to break it all down. Let's kick things off with the broader market. The Dow is now down almost 1,700 points, on pace for its worst day since December 2008 and looking to close at its lowest level since January 2019. The S&P 500 plunging more than 7% at the open. That caused a circuit breaker to actually halt trading for 15 minutes, reopened, and now we're seeing the S&P fall sharply as well to the tune of 6.3%, looking at its worst day since 2011, though I think May 2010 is also in play here. That was the day we saw the flash crash. I mean, it is broad and it is large, Mike.
Yeah.
A lot has to do with oil, and I guess a lot has to do with the coronavirus. How would you put it into context?
I would say it's a kind of complex correction in that sense, in that you basically have all these different elements that are pushing the market around. I think today you get to further extremes, right? A week ago you were able to say, wow, this market's getting a little bit oversold in the short term. 18% in 3 weeks, it's a pretty big bite. I think it probably takes incremental bad news on a very immediate tactical basis to get it too much lower, unless we have something blow loose in hedge fund land or in credit markets. But that being said, I don't think you've created true absolute value cushion under this market, because we started from an expensive spot. So I think you can kind of play that both sides and say, wow, we really ought to be rallying here. That time in 2011, Sarah, you mentioned we were down 6.66% on a Monday, and you did rally big the next day, but it wasn't over for the correction.
Peter, you were cautious before all of this, so congrats on that. Where are you now on this? You starting to turn more constructive or still not?
I agree with Mike. I don't think there's enough of an equity cushion underneath the market yet. I think when we look at it fundamentally, if we really do think there's a 5% contraction in earnings, which we've lowered our base case, which was at the beginning of the year for flat earnings, to down 5, and we look at a reasonable multiple based on what we think our equity risk premium model tells us, about 16 times, you're looking 2,450 to 2,500, which would be the sort of equilibrating fundamental anchor, let's call it. But we know that markets trade excessively out of disequilibrium often. And it was my view, as you guys well know, I came on here bearish quite a bit when the market was in my face. And I said, look, I can't buy into this rally for lots of different reasons. And I think we're getting close to where we should be fundamentally, albeit still not quite there yet.
Now, energy, of course, has been in the eye of the storm today. The sector down sharply to the tune of about 18 or 19%. It's on pace for its worst individual day ever. The move comes as oil prices dived in the session on fears of a price war between Saudi Arabia and Russia. WTI crude saw its worst day since 1991. Energy stocks taking a massive hit because of that. ConocoPhillips and Chevron faring better than others, hitting levels, though, still not seen since 2016. Meanwhile, Exxon hitting its lowest level since 2004. Halliburton, its lowest level since 2002. Mike, interestingly, the majors, if we focus on them here, down sort of 10%, 12%. BP and Shell down close to 20%. I mean, that is pretty extraordinary moves for companies that, relative to the rest of their sector, have strong balance sheets. And I don't think any of the analysts you speak to, including the ones we had on earlier, think that those companies, the majors, have any questions about their long-term future.
Right, and they're not as leveraged to the actual commodity price. The majors are not as much as the exploration guys. It's a give-up trade, I think, in energy. It basically says this is going to be just too hard for too much of the industry. We're not really talking about growth mode. We're talking about shrinking. We're talking about, bankruptcies and all the rest of it. The most interesting question market-wide for me is whether the corporate bond market can sequester energy away from the rest, and whether we can say, look, this is a blasted out area, it's got to take pain, and not have it filter into other types of corporate credit. I think it's an open question, but that to me is going to be a big tell in terms of whether the stock market can kind of find.
Well, the other question to me, which I think relates to the overall stock market, is, Peter, even though it's a small section of the stock market, these energy stocks, what about the economic impact on the U.S. economy? How big of a deal is that if we start to see energy companies fall, and what will it mean for our growth?
Certainly, it's been an area of jobs growth for quite some time. And by the way, just to sort of take it back for a second, the reason why a lot of these E&P companies have been able to survive is because rates have been so low. Low rates have created a lot of overcapacity in E&P for companies that should not have survived, that are still burning cash. That has led to the necessity of this global oil price shock. So this is, to me, a consequence, an unintended consequence of low rates for far too long. And even beyond where we're talking about the importance of E&P companies to the economy, it's an indication that there are probably other areas that are stretched as well in corporate credit, well beyond, I think, E&P.
I think it also has political ramifications, as I mentioned earlier. Texas, Arkansas, a lot of these hard-hit states, North Dakota, they were all Trump states in the 2016 election. So, I mean, any pain there could have ripple effects as well. Airlines also getting crushed. The ARCA airline index down more than 30% so far this year, down 6% today. This as the CDC is urging people to avoid unnecessary travel. American, United, Alaska, and Delta Airlines all down more than 30% from their 52-week highs, Lindsay. When do these airlines get too cheap?
It's a good question. I think that we're going to have to see stabilization in airline travel. The good news for these guys is oil prices coming down, right, too. That could be a silver lining for them, too. But, again, it gets back to that big question of uncertainty. When are oil prices going to bottom? What is the economic impact from coronavirus here and globally? When is China going to get back on its feet? When is the 10-year going to stabilize?
That said, if you're looking for a silver lining, and maybe a bronze lining, these stocks, or some of them, are actually above their intraday lows on Friday.
Right.
Because they tanked to the open on Friday and they recovered, which, given that they are in the eye of the storm for various structural reasons, is a small bronze lining.
It is pretty small right now. I mean, I do think it's a high fixed cost business that if you have idled capacity and top lines going down, it's not a good story. But they also at least screen out as looking not all that expensive if the balance sheet is okay. And I think we might be talking about post 9/11 style government support of some sort for parts of the travel and airline industries. Who knows if this drags on.
Let's move on to tech with 5 minutes left of the session. John Fort has a look at how that sector's performing today. Hey, John.
Hey, Wilf. Yeah, here's a quick rundown of the landscape, really starting with the S&P Information Technology Index. 1441 would be the bear market level there, down 20%. We're not quite there yet, about 20 points away, but some big individual tech stocks inside and outside that index are. VMware, Cisco, and Intel have all lost more than a quarter of their value since their 52-week highs. VMware has lost almost half. Now, on the flip side, Netflix, Intuit, and Alibaba have lost less than 15% of their value. Stay home, watch TV, pay your taxes. Today's worst performers in tech include recent high flyers like Tesla, Shopify, and Micron, all down 10% or more, while suffering least Chinese e-commerce player Pinduoduo, video conference player Zoom, and enterprise software giant Oracle, though that one is near the lows where it's been trading for the past 2 years, guys.
John Fort, John, thank you. How do you approach tech right now, Peter?
Well, I'm cautious there, too. I mean, valuations have come in quite a bit.
Even at the stay-at-home stocks like Netflix?
No, I mean, you have to differentiate clearly, right? But when you talk about cyclicals like semiconductors, and I've been making a late cycle case for a little while now, and, they've been sort of the poster child for overvaluation, in my view, given where we are in the cycle.
What do you like instead?
Well, I've liked the REITs. I've liked them because of my view on rates. Our view has been rates would be lower. Our view is that the curve would invert this year, and for that reason, you get a tailwind for cap rates in a lower rate environment. So we've liked the REITs.
Are there any pockets of tech, Lindsay, that you would be buying?
Well, I do think that some of the software companies that have come in on the back of this pullback could be more interesting now, given the valuations coming in. But also, I think just more broadly, if you look at the NASDAQ action in the last week, on certain down days, they've been down. That index has been down less than the larger cap S&P 500 index. So I don't know if that shows that investors are still willing to put some of their money into these types of cyclical sectors, because when we usually come back from big sharp pull-offs like this, you see the cyclical sectors bounce fast.
Mike, what are you seeing in the market internals?
It's a washout. If you just look at the New York Stock Exchange up versus down volume, it's like more than 95% to the downside. As I said, you're getting more extremes in this comprehensive selling we've seen today. Then take a look at new highs versus new lows. Something like half of all New York Stock Exchange stocks, more than half, made a new 52-week low today. So what you can say is a ton of selling has happened at a concentrated period of time. It's the makings for some kind of relief out there, but you can't really necessarily say it is right now. And then the volatility index, it is up. It's telling you that things are still treacherous. There's a massive hedging bid in there. It's well off its highs for the day, around 60 or low 60s, but still telling you that this is an extraordinarily dicey tape, at least right now. So the contrary thing is when it spikes and comes down hard, that tells you maybe the fever is broken. Before it spikes, when it's still elevated like this, be careful.
Yeah, there's a lot of spiking going on. We've got just about 2 minutes to go here. Let's go uptown to Frank Holland at the NASDAQ. Frank.
Hey there, Sarah. The NASDAQ falling as we approach the bell, down just about 7%, crossing the threshold to be one of the worst days since the financial crisis. Chip stocks and tech stocks taking some of the biggest hits during the sell-off. Tesla down right around 12%. Lower gas prices, another headwind for that company. Mercado Libre and CDW both down around 11%. Consumer stocks also taking a big hit as part of the sell-off. Now tossing things back over to Wilfred with more. Wilfred?
We've got just under 90 seconds left of this roller coaster session. The S&P is down 7.3%. Just today, it was down more than 8% at the lows, so we're not far off those lows. 7.4% as we approach the close. Energy in the eye of the storm. Here is ExxonMobil. This is a giant major with a relatively strong balance sheet. It is down 12%. Why? Because oil prices have tanked. They're down about 26% just today as we approach the close. What else has suffered significantly? Banks. Here's Bank of America since the start of the year, from peak to trough February to today, down 38%. It's down about 15% just today. Why? Because of the move in yields, which continue to slip. We're off the lows today, but we are still about 0.5% on the 10-year. The best performing sectors today are the defensive ones like staples and healthcare. They're still down about 4% themselves. Bringing in Bob Pisani as we approach the close. Here's a snapshot of all of the markets. We are down, Bob, as we approach those 7.5%.
Yeah, the important thing is the test of the circuit breaker system today. The first 15 minutes, the system held up fairly well. If you'll notice, things were much calmer after that. There'll be a lot of post-mortems on this. It's the first one we've even had in the modern era. But for the moment, it appears to be past that test. We are down more than where the circuit breakers kicked in this morning. The S&P closing down 7.7% in points term on the Dow, over 2,000 points. Sarah, back to you.
That is the worst point drop for the Dow ever. Welcome to Closing Bell, everyone. I'm Sarah Eisen. Wilfred Frost rejoining me in just a moment, along with Mike Santoli, CNBC's senior markets commentator. Take a look at this ugly, ugly day on Wall Street. The Dow closing down 7.8%. Worst day for the Dow since December 2008. And as I mentioned, worst point decline ever. The S&P 500 losing 7.6%. Worst day for that index since December 1st, 2008 as well. The tech-heavy NASDAQ also getting crushed. This was a broad selling day, down 7.3%. Worst day, it looks like, for the NASDAQ since 2011. The Russell 2000 index of small caps also getting smoked. A lot of banks make up that index as well. Banks were among the hardest hit in the market. Russell 2000 down 9.44% on the close. Energy got hit the hardest after crude oil declined almost 25% as Saudi launches a price war in the middle of what is perceived to be a big shock in demand from the coronavirus fears. Oil, by far the worst performing group in the market. Coming up, Mad Money's Jim Cramer joins us with his thoughts on this massive market sell-off. He'll tell us what he thinks you should be doing right now with your money. Joining us to talk about the market today, Eric Knudsen. He is multi-asset CIO at Neuberger Berman, which manages $365 billion in assets. Still with us is Peter Cecchini, Cantor Fitzgerald Global Market Chief Strategist, Lindsay Bell, Chief Investment Strategist at Ally Invest. So first, Mike, to you on what we just witnessed today.
It's brutal. Obviously brutal. I mean, the markets rushed toward a place to say we have to start handicapping the probabilities of a recession in this country. Certainly, we haven't priced that in right yet. The verdict is not yet in. I think you could probably look at the washout conditions in the market and start to make a case that there's been enough selling for now. If it was just an equity story, I do think everyone has one eye, though, on what credit spreads are doing and just the volatility readings out there, which suggest a certain contingent of market players are kind of trapped in forced hedging, and there's a lot of unease and bad vibrations in the market. That's the way it is before you
10-year spread, not to get too esoteric, intraday moved 30 basis points. It was down 20 and then it was up 10. It's really a really interesting time in the rates market. So what I would like to see is a bit of a steepening in the yield curve, which likely cannot happen because Fed funds right now is still well above the 10-year. So I'm actually expecting the Fed to move at its next meeting with another series of cuts, and then perhaps I will get more constructive. But the problem is the fundamentals have been weak for a while, and the coronavirus is just, as I've been saying, an extremely heavy straw on a very weak camel's back.
So junk spreads have jumped the last 2 days, but they're still below where they were in 2015, 2016. So do you think we get to that level or above before the pain is over?
Well, I'll tell you, it's interesting. You know, I grew up in a world where credit markets led equities every time. A couple cycles that I have lived through, that was the case. Now I think it's different, and I think the equity cushion under credit spreads has allowed for a relative value mindset that has persisted for a long time. In other words, if you're taking down a new issue and a company has a massive first loss cushion beneath you, you're really not all that worried about being repaid. But suddenly, as your equity cushion diminishes, you say, oh my goodness, maybe I don't care about that extra 10 basis points on the break. I really care more about whether or not I'm going to get repaid at the end of the day.
Eric,
and that's the shift.
Just want to bring you in here, Eric. What are you doing and what are you telling people to do on a day like today?
Well, first of all, we were telling people this morning that they should get ready for a long haul, that this was not going to be resolved quickly. As we met with our senior investors at our firm over the weekend, we identified a couple things that we were watching for. One was we observed that up until Thursday, Friday, this sell-off had been actually pretty orderly. Correlations had held. Stocks were going down, rates were going down, but credit spreads hadn't widened that much. We started seeing that change Thursday and Friday, and we identified a couple things that we thought were going to potentially drive a very sloppy day today. One is we observed that the oil price drop really put the market in double jeopardy because that has more of an impact on credit. And we expected a pretty ugly day for credit today, and we got it. The other thing we observed is that you hadn't really seen a big, and one of the identifiers we picked up was a multi-thousand point drop on the Dow, and that would indicate that we had really gotten into the selling and very negative sentiment, and we just got it. So we identified a couple levels where we wanted to, where client portfolios were underweight equity, and we did come into the weekend underweight equity, add some equity exposure, and we began doing that this afternoon. 2720 on the Dow is a 20% drop. That's an important support level. We're adding just above that level, and we're also looking to take advantage of this higher volatility by selling options on equity indexes to say we're willing to get paid a lot right now to buy equity at lower levels from here.
Eric, what did you buy in the equity market? Broad indices, or were there sectors or stock specifics?
Yeah, from a multi-asset standpoint, we just implemented with S&P futures, partly for ease of liquidity and implementation, and partly because it reflects a quality orientation, and that's something we want at this point. It's not yet time to go looking for kind of deep value or bombed out areas of the markets.
Okay, let's get a summary, by the way, on this crazy day that we just had. Bob Pisani's on the floor of the exchange with a breakdown of a crazy day, as I said. Bob.
Yeah, and so the good news is the circuit breakers kicked in very early, added liquidity, calmed the markets a little. The bad news, of course, we did end of the lows for the day. Energy down 18, banks down 14, industrials down 8%. I just want to show you ExxonMobil down, roughly 11% on the day. This would be the lowest close for Exxon since 2004, believe it or not. JP Morgan Chase down 13% or so. That was the worst decline since March of 2000. You got to go back to the financial crisis to see a decline of that and this kind of percentage on a daily basis. Industrials generally fared poorly. Caterpillar and 3M as well. 3M down 5%. They're 6%. I'm sorry. You see that? That's a 4-year low for 3M. And Dow Inc., which you can associate with the truly global industrial materials economy, global coatings. Think that is not a typo there, down 21%. Remember, it just came back to the public markets about a year ago. That is, of course, a new low for that stock. Guys, back to you.
All right, Bob, thanks. Another historic day as well for the bond market. Let's go to Rick Santelli at the CME in Chicago. Rick.
Hi, Sarah. You know, markets right now are trading some very important levels. Look at a 24-hour of 10s and realize that Friday's low yield in 10s was 65.65. Right now, today's high was 60, and that was after a 31 print. And the point is we're trading 59 now. If we leave gaps, and we left a gap, and we go down below the lows, which are 31 before we fill that gap, that is much more bearish for lower rates. So filling this gap and what we do once we do is significant. Finally, if you look at the long-term chart of 10s, a lot of it's technical. The minute you took out those double bottoms in 12 and 16, it accelerated. Dollar index, as soon as you took out, see the year to date, where it closed last year, it accelerated. This is important. Uncertainty is always addressed by technical features, so you need to stay on top of them. Sarah, back to you.
All right, Rick, thank you. Energy stocks got absolutely crushed today. Our next guest downgraded almost every exploration and production company he covers on what he says is a potential energy Armageddon. Joining us now is Neil Dingman, Managing Director of Energy Research at SunTrust Robinson Humphrey. Explain what you mean, energy Armageddon. I mean, we got a taste of it today, but how much more is likely to come?
Yeah, thanks, Sarah. You know, again, you hit it earlier, and that is it's unprecedented to see this kind of pressure, both not only on the supply side but the demand side. Again, here we don't know what the fully demand destruction is going to be, nor do we know how much the supply war is going to cause supply to continue to ratchet up. So standing back, taking a look at that, we thought, you know, prices certainly could get on the 20s. We have seen that, and we think they could stay there for a little while.
Peter, just want to come back to what the stocks have done today. Do you think the oil stocks are suggesting large swathes of this industry are going to go bust, or is it just a move based on earnings estimates have to come down?
Well, I think, again, you've got to bifurcate. So similar to your technology names, the big companies that have, you know, good balance sheets will likely survive, and that'll be an advantage to them. But the smaller guys that have access, that need access to capital markets that are cash flow negative, will suffer, and the privates will likely go under very, very swiftly.
Talk about within your coverage, Neil, who's going to suffer most, and what does that suffering actually mean with the price of oil at $31 a barrel?
And there's definitely a number of names that have both maturities and, you know, sir, there's the RBL redetermination coming up. So when you look, some large companies, Oxy obviously has a lot of debt, Anadarko merger. Chesapeake, of course, has a lot of debt outstanding, as does even, you know, better credit such as an Apache. All those have relatively high levers with some maturities coming that they're going to have to address, you know, just for some large companies there.
Well, what's the key, Neil, what's the key oil price and the length that has to remain below before those companies start to feel the pressure seriously? Is it 1 month where we already are, or do we need to see another leg down and it lasts for the rest of it?
You know, most of these companies, again, they've got to be closer to $40. So, again, we're obviously quite a ways from that. So, to me, if we're down, let's call it 2 quarters, well into the back half of this year, and we're still under $40, it definitely will be troublesome. I don't think, I'd put it this way, Wilfred, I don't think any of my companies make free cash flow at $40. They're going to have to figure out other things. In fact, direct quotes from my CEOs today said, it's all about survival for us. It's not about valuation, and I think that's very much what most of them are looking at.
You know, the president tweeted out, Mike, today on the oil prices that, you know, gasoline prices go down for Americans. That's good. It puts money in their pocket. If you look at what stocks actually went up in the S&P, I think there were under 10 of them. One was Dollar Tree. I thought the other Dollar Store
was
one.
up for part of the day
Walmart,
as well.
Clorox. I mean, there are, you know, there is a silver lining for the consumer. Sure. I'm not sure, though, if you have coronavirus fears, you're going to go out and spend that money.
Right. I mean, the buying of necessities trade will work in this environment. I still don't think that from a stock market perspective, the small windfall in terms of price per gallon is that significant. Because the oil intensity, you know, this is not as big a portion of the consumer expenditure set as it used to be. It doesn't hurt. It's an offset, but I don't think it really changes what's going to be a real retrenchment cycle in the energy industry.
The amount of jobs lost that the energy patch is going to have to go through, I think is going to have a much bigger impact than the couple dollars that families are going to have to spend from the savings in oil.
Peter, is there a sector you'd buy today?
Again, my favorite amongst the
REITs.
carnage is the REITs, and I've been singing that song. I'm sticking to it.
I get excited about.
Yeah.
Eric, final question to you. Is there a US S&P 500 sector you'd buy today?
again, quality and yield, we think that once the dust settles here, where you look at where treasuries are, there's going to be such a demand for yield. So we're looking at quality and we're looking at yield, so REITs can certainly work. We're also looking on the bond side. We think there are going to be some really interesting opportunities to be a liquidity provider and investment-grade credit. And there's going to be a lot of demand for those bonds. And right now, you can pick some up at a pretty good bargain.
Okay, we'll leave it there, everyone. Thank you so much, Neil, Eric, Peter, and Lindsay.
Thank you.
For more on this historic sell-off, let's bring in Mad Money's Jim Cramer. Jim, as always, great to have you with us, particularly on a day like today. I just want to read out some of these statistics for you. This is the worst point drop for the Dow ever, the worst percentage drop for the S&P 500 since October 2008. Jim, do you feel that you're getting reminded of the 08-09 financial crisis on days like today?
No, I think I see much more of a reminder of the J-Powell bear market. And unfortunately, we're still not to where we were in the bottom of the Christmas week of 2018. We fell down there, S&P 2339, Dow 21770. I think those are good levels because I think that people think, listen, it's going to be a recession. And if it's going to be a recession, then we still have a little bit more to go. I did see some things to buy from my travel trust the other day. First time we bought anything. Because there's just such declines in the pharmaceuticals, which I think should hold up. I just saw Sarah mention that the Dollar Generals and the AutoZones go up, and that's okay. I get that. There's a recession, but I want yield, and there's finally some yield, and it's great to see.
Where are you looking for that yield? Which sector in particular?
Well, I've got to tell you, I look at AbbVie, and I think I can't believe I'm getting that gift. How about Bristol Myers back over 3%? Bristol just made that acquisition with Celgene. They've got some huge cost savings coming, and it'll be accelerated buyback they're doing. There's just so much to like about it, Bristol. Because I say like about it because you can buy it here, and if it goes down, which it could because it's part of the S&P, then you can buy more of it, and that's what I'm really looking for. I'm looking for situations where it could go down, and you don't say, oh, I got it wrong. You can say it went down. I say, oh, good, I like that. So I think that's good. I don't even mind Amazon here. I think that you can buy some Amazon and then buy some more just on a scale because, holy cow, if you really stand at home, that's the only way to shop.
Jim, I'm looking at my dashboard here. JP Morgan Chase, 3.85% dividend yield. What do you make of that?
I'll tell you which one you want to go. I'll see you one and raise you one. How about Charlie Scharf at 6% without the problem of Elizabeth Duke being the chair? I mean, don't you think that's interesting? I mean, there you got a guy with a full new slate of people with Maxine Waters all over him, and he didn't do anything. So I kind of even like that. 6% with Charlie Scharf. I'll bank with Charlie.
On that point, though, Jim, one big question that always comes out when people say, oh, it looks like it's a good dividend yield, but might that be a sign the dividend is going to be cut? With the banks, do you take strength on the fact that they've got a lot of buybacks they could cut first, that those yields, 3 to 6%, whichever one we're looking at, are very safe?
Exactly. Look, if Mike Corbett doesn't want to continue to buy 8% of the company back because it's below book, and that's tangible book, he can stop doing that if he wants to. I look at something like JP Morgan. Obviously, yes, we want Jamie to wish best of health, but it really is amazing. I think if actually Jamie were back at his desk, he would feel, well, wait a second, I'm getting a chance. I know people hate the banks. I heard all day that the oil companies can bring down the banks. That is actually not true. I didn't like the fact that JP Morgan apparently did a revolver with one of the cruise ship companies because I think the cruise ships have become wasting assets. But when we look at the oil companies, they're not all knuckleheads. They're not all Occidental.
Just on the broader market, Jim, there are so many uncertainties right now on coronavirus. How many actual cases are there in the U.S.? Right. What does the mortality rate actually look like? I mean, what do you think it's going to take for the market to be able to see out onto the other side? What is the headline or the news?
We want some sort of fiscal commitment. We want public health to have all the money at once. We want a Manhattan Project to try to solve this. And we want the test kits. I mean, you take a look at Japan. They have not had their numbers are peaking. And the main bulk of the numbers are from a cruise ship. I would love to see our numbers peak. I don't want to be Italy. I want to see what happens in South Korea. And I'd like to be able to test. With the test kits, I know my confidence would come back. I understand that the president wants to tweet that all is well. I think you have to hope for the best and prepare for the worst. You don't just hope for the best. That is a sucker's game.
Jim, you mentioned they're not all knuckleheads in the oil industry, and we've seen some massive moves today, even not followed in line with that?
I think that would be a mistake because these companies are no longer a big part of the S&P. The Occidental shoe has to fall. The Occidental shoes have to fall. There you saw the bonds trade down 25 points today. The big 49 bond, the four and change 49 bond. You can't. I think that when that goes and you see it as the lead story in the paper, and Warren Buffett lost a lot of money on it, if that does happen, I think that could cause another leg down in that group. But what I'm looking at is you remember the banks were stress tested 25, 26 for the oils. I feel better about the banks than I do any oil company. Any oil company.
Jim, just overall, I mean, is it panic? What do you say to the extreme
I wish
sentiment
it were,
shift?
Sarah. You know, they did the halts, and suddenly everybody's calm and they're picking. You know, the picking thing doesn't work. We got to wait for this is a different market because we didn't count on the oil problem. Before the oil problem, we thought maybe we're okay. And look, I want to believe the president. I want to believe that if we tested everybody, everything's pretty good. That would be terrific. But the fact is, people are working at home, deals aren't closing, restaurants are hurting. There's no backstop of no interest loans for the people who, frankly, deserve it because they're hardworking people. When I speak to Dave Tepper, I know that earlier Steve Leisman talked to Dave Tepper, and I know he made it sound like that Tepper's like, hey, you know, sanguine about some things, an orderly bond market. But we both feel that without fiscal stimulus and some kind of more aggressive leadership from Washington, we're going to run into another down day like this until we get to where Jay Powell put us in December of 2018.
I do think it was notable that, you know, there were reports, and Eamon Javers reporting earlier that the Trump administration, the economic team, is starting to weigh measures to deal with this, you know, paying for sick leave and business, but it didn't really do much to give the market a confidence boost.
Well, they didn't really come out. I mean, you know, plus you have Senator Mnuchin. I think he needs to come out because the president's got himself in a bit of a box. I mean, if everything's so darn good like he says, then how do you therefore then offer these different programs for the small and medium-sized businesses, which we know will be crushed? And you know, any of us who have small and medium-sized businesses, we're looking and saying, okay, if we have 4 or 5 bad weeks, can we carry people? Can we carry people? Yeah, these are totally legitimate businesses all over the country. Where can we carry them? And so I think that that's a big problem. And I think that the credit issues that drive JP Morgan down 14, American Express down a lot, you know, these travel and leisure and credit card are frightening people. And I wish that they didn't, but they are frightening people. So I expect another day that's not so hot, if not multiple days, if the COVID really heats up again, which I think we all think it will. Do you guys think so?
Jim Craig?
Are you worried?
I think it's hard to predict on an individual day,
worried?
but
do you wash your hands all day and wear Perel?
I wash my hands all day, but I'm
all day. I wear
I'm not too worried outside of that. No, but I take cautions. Like everyone should take cautions, and I'm not going to unnecessarily get on a plane, and I'm definitely going to wash my hands a lot. Jim,
well,
we're going to listen to Dr. Fauci, right?
Look, I love Dr. Fauci. That last line, man, Royal Caribbean. I mean, can you imagine if you're like watching that show? He said, "Don't take a cruise ship." It's like, whoa, okay, let me do some cancellation of that.
Jim Cramer, as always, a pleasure. Thank you so much for joining us here on Closing Bell. Don't forget to catch more of Jim tonight, 6 p.m. on Mad Money. Joining us now to discuss things further, Neil Ferguson, who's out with an op-ed in the Wall Street Journal today. It said, quote, network effects multiply a viral threat. Detailed how coronavirus is spreading faster than most Americans realize. He joins us now. He's, of course, senior fellow at the Hoover Institute. Neil, good to see you. Thanks so much for joining us. I guess the first question is your take on where we are on the scale of acceptance of how serious this virus is, and whether there's a lot more realization of bad news of the reality to come.
Well, the answer, Wilfred, is that we don't know where we are because the United States is lagging behind on testing to see how many people actually have got the COVID-19. disease. Now, the indications are that the United States should be as exposed as almost any country to infection from China. That's one of the things that the network scientists at Northeastern University have shown, and I quoted that in my Wall Street Journal piece. We are very integrated, the United States, and particularly the West Coast, into China. And so a lot of people came here from China in January and even into February. The probability is that we don't have hundreds of people with the virus. It's more likely thousands, and in fact, plausibly tens of thousands. So we still don't know that, and we won't know it for possibly weeks because there has been such a shortfall in testing. But everything we know about network science and epidemiology tells us that it's highly likely that some parts of the United States will have a South Korean, if not an Italian-style experience. And so it's very early in the game in the United States, but you have to look at what's happening in those countries and project forward a few weeks and imagine the United States in that situation. Anybody who's not doing that is living in the same box that President Trump is in, as Jim Craper just mentioned, telling themselves, oh, it's no worse than the flu, it's just going to be the flu. But that actually is completely wrong, because the mortality rate is likely to be significantly higher for the flu, and we don't have the kind of herd immunity that we have to influenza. We don't have the kind of vaccinations that we have for influenza. This is a new coronavirus. It is not the flu, and therefore its impact, as we've seen in the rest of the world, is likely to be really quite considerable, particularly for elderly people.
Yeah, you mentioned the president's response, Neil. It's something I wanted to ask you, because I know in all of your work as a historian and an author, you've looked really closely at leadership, and you've said very positive things about President Trump in the past. So what do you think is the disconnect here between what we're getting from the administration, what we're seeing in the markets, and what the truth actually is?
The test of any president is the crisis. And what's been a striking feature of the Trump administration has been that actually the crisis took until the year of his re-election to happen. If you look back, let's just take the presidency of George W. Bush. You can see two quite different effects. 9/11, which was a huge shock, in some ways comparable to the shock of COVID-19, led President Bush to show his greatest strength, actually. The response that he gave, defiance, leadership, vengefulness, resonated with the American public and helped the US overcome that shock. It also made him very popular. But when President Bush was hit by the financial crisis in 2008, he looked clueless and his popularity imploded. Luckily for him, he wasn't up for re-election because he'd served 2 terms. Or look at his handling of Katrina, which happened in 2005 after he'd secured a 2nd term. If he'd flunked Katrina the year before, if that hurricane had struck New Orleans 2004, he might have been a 1-term president. I worry that President Trump has got on the wrong side of this, but the line he's taking, tweeted out again today, that it's just another influenza, is going to come back to haunt him in this election year. And I'm afraid it's just not in line with the science of what an epidemic like this, indeed a pandemic, which it is in all but name, does. Not just in terms of mortality and sickness, but also in terms of the effects that it has on public confidence. And I think when you look at what's happening, not only in Asian economies that have been affected, but also in Europe, you see that the effect of consumer confidence tanking is really very profound economically.
So Neil, what about President Xi Jinping then? I mean, to what extent? I know we don't get very trustworthy opinion polls coming out of China, but to what extent would opinion in his leadership have fallen? And where do you stand on how big the economic impact is going to be on China?
Well, the economic shock was very great indeed, as you can see in the PMIs, really unprecedented declines in economic activity because of the quarantine measures that had to be imposed on Hubei and indeed the restrictions on movement in China as a whole. The line that they're now taking in Beijing is that we're getting back to normal, Hubei's going back to normal. It's early to be doing that, and there is a significant risk that you get a second wave of infections. But I think what's happened is that China's leadership bungled this in the first phase, really denying that there was a crisis until it was very far advanced in Wuhan and Hubei province. But then, because they have a one-party totalitarian regime, they were able to impose the most drastic quarantine that I think there has ever been in human history. What I don't think is going to happen is that Western democratic governments are going to be able to replicate that. Even although they're trying in Italy, it's very hard for a democracy to do what they did in China. So I think the big question, which as I said is still in the realm of the unknowns, is how significant a problem is there going to be, not just in Washington state, in California, but potentially in New York, indeed in other states that already are showing signs of having the beginnings of that exponential growth in confirmed cases that we've seen in so many other countries. If you get something like South Korea or Italy, it's very difficult for the United States to act like Xi Jinping and quarantine a state. And that, I think, means that the response in democracies is likely to be less drastic and therefore less effective than the response we saw in China.
Neil Ferguson, as always, thank you very much.
My pleasure, Wilfred.
And don't forget tonight, tune in 7 p.m. Eastern Time, a special Markets in Turmoil. Again, crucial viewing amid this crazy volatility.
Let's go back to Mike Santoli for the third dashboard of the day. Mike.
Yeah, so I wanted to zoom in on a couple of sectors of the market or styles of investing. Take a look at the Invesco Buyback Achievers ETF compared to the S&P 500 itself. This is only over 6 months. And you see really this vertical move down, vast underperformance for the buybacks. Like now, one of the things that kept the buyback story afloat, of course, was corporate debt markets being in good shape. Now you'd have a lot of financials in this buyback ETF as well, but that's a theme that seems to have been derailed, even if perhaps it was over-credited for its force on the way up in the bull market. Take a look too at the transports. We did kind of glimpse those earlier, but this I like goes back to 2015. We are at levels on the Dow Transportation Average we first reached 6 years ago. So it's not just that, oh, we've kind of hit the skids in the market and the tariffs and all the rest of it. You have to basically, you're down on a 6-year basis here, a 5-year basis, and you even have to go back further to 2014. FedEx down to levels seen 6.5 years ago. So clearly, you've really stripped away a lot of expectations for what global growth can produce for this sector. Is it enough? We simply don't know. You have overshoots to the downside as well as the upside markets.
Mike, thanks very much for that. We will dive into that analysis in a moment. But first of all, breaking news. Steve has got it for us on the Fed. Steve.
Thanks very much. Well, 6 financial regulators, including the Federal Reserve, the FDIC, the control of the currency, urging some regulatory relief or supervisory relief for banks, for businesses and credits affected by the coronavirus. Regulators say banks should work with their customers in affected communities and to basically talk to them and try to work things out over time. This is very similar, Will, to the kind of guidance that we get in an area after a hurricane or other natural disaster. Something we talked about could be coming from the regulators a couple weeks ago, and now they're out with this saying, work with your borrowers and work with supervisors to try to get over the hump of whatever credit problems might ensue from the coronavirus. Sarah?
But Steve, bank stocks, I can't remember off the top of my head. Bank of America was down 15% today. It was down close to 40% from its February peak. Is this essentially saying banks should take the hit in the short term?
No, here's what it's saying. You've seen these before. They have done this many, many times before, and you've seen these where what they say is if a borrower's having trouble making a payment because of the virus that's out there, or in other cases of the hurricane, the supervisors are not going to swoop in and penalize you for not taking action on that bad credit that's in place there. This is a situation where they're saying, we're going to provide supervisory relief or supervisory oversight, where we're going to say, okay, you guys, that is okay for now. I mean, if we get a year from now and it's still a bad credit, we're going to penalize you, but we're not going to do it now.
All I would say on that, Steve, I totally get your point. It's like that kind of expectation sort of goes without saying. It's not like this is a groundbreaking shift in support. Not that you're framing it that way anyway. In a way that I think markets are waiting and looking to hear from as to whether we actually get genuine help from the government to say we will make sure these companies don't need to let the banks down.
Well, that is a very different story, Wolf, and you and many other people, including members of the Federal Reserve, are waiting for that from the fiscal side. The Fed here doing what it can do, and I would just offer, if it needed saying, that I don't think they would say it. Apparently, this is an important piece of the whole regulatory framework for them to step forward and say, don't worry about this.
I think the Fed is in its crisis playbook here, and the federal government is not. Is that what's happening?
I think if you were to measure who is further down the line of thinking this is important and they need to act, certainly the Federal Reserve is taking substantial actions. And as you know, Sarah, they're expecting to take much more substantial actions.
Steve, thank you.
Pleasure.
Our next guest says a credit crisis is more likely to trigger a global recession than the current stock market meltdown. Joining us now is Nouriel Roubini, chairman of Roubini Macro Associates and professor of economics at NYU's Stern School of Business. Nice to see you.
Great seeing you.
What are you worried about with the credit market?
Well, the stock market has a wealth effect, but since there is a massive amount of inequality, even a 20% fall in the market is not going to lead to a recession. While I think that the seizure of the credit markets has a much more severe impact on the economy. You saw what happened, in 2016 or 2018. We have leveraged loans, we have CLOs, we have $1 trillion of fallen angels in high grade, and we have all the junk bonds in high yield. In 16, spreads went from 300 to 900 in a matter of a month. If they'd stayed there for 6 months, the Fed believed it will have a recession. This time around is worse because at that time, first of all, you had only a growth fear right now about China, US. Right now it's much more serious. China is going down, the rest of Europe, US is going to go down. Secondly, it's not just the oil market. At that time, oil went to 30. Right now it's below 30. And it's not just oil, it's all the service sector is highly leveraged. It's going to be in trouble. There is more debt. You have all the situation of SMEs and households that are illiquid but solvent, but if they don't get debt relief, they're going to be in trouble. And we've had 3 more years of increasing debt and leverage in the system and the corporate sector. And compared to 16, the room for the policy response is much less than before. We're running out of bullets. So you put it all together, is much worse than what happened in the first quarter of 16 or the fourth quarter of 18. It's going to be much worse. And the trigger for the recession is going to be the stock market, but the credit crisis. And we're in the beginning of a complete seizure of credit market. There is no issuance in the primary market of leverage loans, of CLOs, of high yield or high grade. It's totally shut down.
So worse than 2016, you're saying?
Much worse.
Will it be as bad as 2008? What level of recession are you now expecting?
Well, first of all, I expect there's going to be a recession because Q1 growth in the world will be for sure negative, given you have negative growth in China, in Japan, in Korea, in Italy, and US will have barely 1% growth, and the Eurozone closer to 0. In the second quarter, given what has happened in China, you're going to have a spread of the contagion to Europe and to the United States. The numbers are fudged down because we're not testing. We know that in the countries where we're testing, the numbers are huge, like in Italy and Korea. Why in the US they are so low and you have high mortality rate? Because we're not testing. Probably we have already 10,000 cases. So in the second quarter, if you have what happens in China, in Europe and United States, you'll have the same situation of a severe economic downturn in the second quarter. So first quarter because of China, second quarter because of US and Europe. And probably in US and Europe it's going to be worse because China had draconian big brother society types of quarantine that we're not going to see in US or in Europe. So most likely in China took 3 months to stop and reach a peak of the contagion. In Europe and US could take 2 quarters, and 2 quarters means you'll have recession in Q1, in Q2, and Q3. And it takes only 2 quarters for having a global recession. So we'll have for sure a global recession. The question is how severe it's going to be.
Nobody's talking about a credit crisis at this point yet, Nouriel. Yes, we've seen a big move, but I mean, what I hear from people is it's not panic, it's just dislocation. There is price discovery. This is an early move, and a lot of it today was energy related.
Well, in 2016, it started as energy, but in a matter of a few weeks, you had contagion from energy to the rest of the high yield. Why? Because when you take losses on energy, you have to cover yourself on the rest of the high yield if you're an investor. And this time around, the shock is not just on energy. You have all the high leverage firms in the corporate sector, especially in services, going down. So there is a fundamental reason why the entire high yield should go down. And in this case, it started from high yield. then leverage loans, then CLOs, then it goes even to high grade, where you have $1 trillion of fallen angels, of firms that used to be high grade, but now they're borderline, they're going to be downgraded to below investment grade, and then it's going to go from there to emerging markets, local currency, foreign currency. As this movie has happened before, the difference, I said, there are 5 differences compared to 16, is much worse today than 16. We're not yet in the debt crisis, but we're at the beginning of a debt crisis. It's the beginning. There's seizure in the market is shut down, nobody can issue, not even the high grade folks. So if this is not a crisis or a beginning of a crisis,
this is why they
what
call
it
you
is.
Dr. Doom.
No, it's not Dr. Doom. It's not Dr. Doom. It's Dr. Realist. Look, I mean, I'm speaking about what's happening. I'm not speaking about something hypothetical. What's doomish about it is the reality of what's happening right now. Let's not use stereotypes. Dr. Doom, it's silly.
No, sure. Why do you say that the room for policy response is less now than 2016, when we had Fed funds rate was at under 0.5% then, now we're at 1%, and we have the same tools as then. Obviously, though, the rest of the world perhaps in a different spot.
Well, the policy rate is almost the same here as before. In the Eurozone in Japan, the policy rates are already very...
now. It was under 0.5% in early 2016.
Yeah. So we're going to use that one. We might use it actually by another 50 basis points by March 18, and things are going to start to be bad only then. During the global financial crisis, we were at 650 and went all the way down to 0, and then we had to do forward guidance, and then QE, and then credit easing, and other things like all the things we did with all the unconventional liquidity things. This time around the world, the policy headroom is more limited than before compared to the global financial crisis. That's a fact, and we know. And we'll see once we go to 0 whether they want to do QE or whether they want to do more convention. By the way, given the supply shock and its partly demand, we know that monetary policy alone is not going to be sufficient. You need massive fiscal stimulus. Take the United States, let alone the rest of the world. There is gridlock. The administration might want a tax cut or a payroll tax cut, and Democrats are going to say, fine, we'll do it if you raise the taxes on the corporate and the rich. They're going to pass it in the House. It's not going to pass in the Senate. The gridlock. Why would the Democrats give this gift to Trump on election year? They're not going to do it, and this growth implies that any fiscal stimulus in the U.S. is going to be tiny compared to what's desirable. People now start to talk about coordination between monetary and fiscal policy. Stan Fisher, Ben Bernanke, this morning, the Redalio on the FT. What does it mean? It means helicopter drop of money. That's a term, right? For helicopter drop of money. You need fiscal policy, and then you have to monetize in the primary market. How likely is that's going to happen, that you have a fiscal stimulus that's going to be immediately monetized? It's maybe the right thing to do, but it's not going to happen. It's not going to happen.
If the S&P 500 down 18% or so from its highs, you think further to go?
Yeah, further to go. A typical recession, the stock market 30 to 40%. During the global financial crisis, went down by at least 60%. Of course, it's not going to be a linear down, because as things get worse, tonight the Fed might actually take some action overnight, not cutting rate, but maybe providing more liberal liquidity, or extending the purchase of T-bills from April until the end of the year, or ease the discount window, or create one of these term auction facilities like they did in 2008. I'm sure they have to do something overnight. What they just announced right now with forbearance for the banks is not going to be enough. So the market can rally for a day or two. Then things get worse, because the fundamental implies that in the next few weeks, the number of cases is going to explode. That's the fundamental. People are going to panic. And then you do it incrementally more, and there'll be a talk about the little fiscal stimulus, $50 billion, what's that, spare change, $100 million, not enough, and so on. And therefore, things are going to get worse, and the policy response is going to be less than desirable and optimal. Therefore, the market can go down 30% or more before they bottom out. The trend is going to be down, and it's going to be a zigzag. It's not going to be linear, but the trend is down. It's not up. We have not reached the bottom based on the fundamentals, and the policy response is not sufficient. So if you extrapolate, it has to get worse before it gets better.
Do you think negative rates are possible in the U.S.?
I think that the Fed, when they're going to do their Fed review, they're going to say, as they have said, yes to zero rate, yes to QE, yes to forward guidance. We don't want to go negative for a bunch of reasons. Some people within the Fed favor, like in Japan, a yield curve control, zero rates on the long end, like Leo Briner. Some people, like Rosenberg, are talking about buying private assets like stocks and so on. I don't think that's politically feasible. You have to pass legislation. So you'll have a bunch of things to do, of course, including QE, but it's going to occur too late, too slowly, and it's not going to be sufficient, because you need the fiscal side to be big, and then the monetary is going to finance it, and we're not going to get a big fiscal stimulus. You need at least a 1% of GDP, or maybe more, of a fiscal stimulus. What is the chance we get that one before the election? I would say close to zero. $200 billion? No way it's going to happen.
I guess let's see what the market does. Maybe they can force the hand like we've seen in the past. Nouriel, thank you. Good to see you.
Good talking.
Nouriel Rubini
prefers the title now, Dr. Realist.
Dr. Realist.
We won't use Dr. Doom, but you must accept you're not Dr. Optimist as well.
I'm Dr. Realist.
Okay.
There are sometimes to be optimist, there are times to be pessimist.
We need to
right
see
now
you
is
more
the
during
time.
the
It's nice to
be
end with a
safe,
smile,
I'm sorry.
regardless.
Yeah.
Anyway, Nouriel, thanks so much for joining us. Crazy moves. So let's have a check in there on the Dow, how we finished, down 7.8%. Dr. Realist striking the right tone if we have repeats of today. Walmart even falling into the red as well at the close. It had been green for most of the session, but all 30 stocks negative, and plenty there at the bottom of double-digit decliners, about 7.
A 2,000-point loss for the Dow, worst day since the financial crisis. Let's get the latest details on how the White House is responding to the coronavirus outbreak and the market meltdown. Eamon Javers with us from Washington. Eamon.
Well, White House officials tell me that meeting with the president and his economic team did begin around 4:15. They told me it was underway here, so that is ongoing. The president is set to be presented with some options for how to respond economically to the coronavirus. Not clear where the White House is going to land, and aides were careful to caution me today to say it's not necessarily guaranteed the president is simply going to pick from a menu of options and make a decision today. We will wait and see what happens when they emerge from that meeting to see if any direction is being set out upon here from the White House. Meanwhile, as the president's making those decisions, congressmen who have been in contact with the president over the past 2 business days are now being self-quarantined. Congressman Matt Gaetz, who was with the president on Air Force One this afternoon, has announced that because he came in contact with someone who potentially had the coronavirus, he is entering self-quarantine. That self-quarantine began after Gaetz got off Air Force One with the president this afternoon. Congressman Doug Collins was with the president on Friday in Atlanta at the CDC. He also now under self-quarantine. Neither congressman, we are told, has any symptoms of coronavirus, but that's sort of what's swirling in the president's worldview as he sits down to have this meeting today. People he's been in contact with are now under self-quarantine. And guys, we're expecting a series of meetings later on this week. Health insurance executives are here tomorrow to meet with Vice President Pence. And then on Wednesday, Wall Street CEOs will be here at the White House to meet with the President of the United States. All of that formulating a response from the private sector in terms of what to do on coronavirus and what kind of help they may need from the federal government. Guys, back over to you.
So, Eamon, you know, as the market was plummeting today, the president was tweeting. And this tweet in particular, I got a lot of commentary about. So last year, the president says 37,000 Americans died from the common flu. It averages between 27,000 and 70,000 per year. Nothing is shut down. Life and the economy go on. At this moment, there are 546 confirmed cases of coronavirus, 22 deaths. Think about that. In other words, continuing, I think, to downplay the severity of COVID-19. The fears in the market, the fears from ordinary Americans. I mean, what is anyone telling him, Eamon, that is completely disconnected with what the market is telling us and what we're hearing from healthcare professionals?
Look, I tried to get a question to the president in as he came into the White House this afternoon. He did not stop to talk to reporters about the market sell-off today. He did bring Brian Urlacher, the former Chicago Bears player, into the residence with him. So he's having a social visit here just before the meeting with the economic team. And look, the president's getting a lot of advice. He sees what's on television. You talk to White House aides, they say, you know, you just don't even need to brief the president on what's happening in the market because he sees it in real time. And I think clearly the impetus behind that tweet is he doesn't want to panic. He wants to put all this in context. But the danger politically is that you do look potentially out of touch, and you look like you're not taking this with the sense of seriousness that it deserves. The president was in Florida today having a fundraiser, for example, not here at the White House until this afternoon. So all those optics matter for a White House and for a presidency. And of course, as we know, these kinds of emergencies, public emergencies and financial emergencies can be life or death stakes for politicians politically in the White House.
Eamon Javers. Eamon, thank you.
You bet.
Take a look at shares of Stitch Fix after hours plunging on earnings. Kate Rogers with the story. Kate.
Hey, Sarah, that's right. Stitch Fix down just about 37% right now. That's on a really mixed quarter here for Q2. EPS a beat 11 cents versus estimates of 6 cents. Revenues, though, a miss here, $451.8 million versus estimates of $452.5. Now, Q3 guidance here on revenues is a bit lighter than expected. The company's saying they believe there's heightened promotional activity across retail and that clients wound up spending less per fix in the current quarter on average, resulting in lower order values than the company had anticipated. They also said they have 3.5 million active clients. That number is up 17% year over year. And also just finally mentioning coronavirus is a fluid situation that they're monitoring, but right now no material impact on their business. That conference call kicks off around 5 p.m. and we'll bring anything else we get. Back over to you.
Can we go there?
Kate Rogers, Kate, thanks. Down 37%, Mike, gives us a taste. I mean, they didn't blame coronavirus, but
No.
it gives us a taste of what the action is going to be around earnings season.
Yes, maybe an extreme example, I would imagine, but this is not the kind of market where you have kind of a show-me story stock that hasn't yet proved it can sustainably, grow into its expectations, going to disappoint like that.
Just want to bring some other news. The Italian Prime Minister just giving a live address moments ago and announcing that the restriction zone will be extended to cover the entire country. No longer just a red zone in the north of Italy, in the Lombardy and surrounding region as it had been. The entire country is now quarantined in that restriction zone. I mean, Mike, we talked earlier in the show, clearly the oil news was a huge part of the story over the weekend. I think seeing a Western democracy move to the sorts of draconian measures that we'd seen in China had also been a big piece of news over the weekend that surprised the market. The entire country, that is quite astonishing.
Right, absolutely. And also the fact that everybody here knows in the U.S. cases are going to go up. We're just on the front end of this spread. But the idea that it could get out of hand and that we're going to be living with this drumbeat for a while, I think is a significant thing. Now, at some point, I keep saying the market is just going to overshoot to the downside to price in a pretty dire scenario that might be a little bit worse than the probable one. So we just don't know where we are in that process right now because we don't have enough numbers in terms of tests to draw the curve and to say we know what we're looking for in terms of the numbers rolling over.
By the way, the Italian stock market today dropping 11% on that, the idea of that lost economic activity.
Yeah, but to that point, I mean, the Dow Jones is down 8%.
Yeah, I guess so.
I mean, just enormous moves all around. And just whilst we bring that up, China was only down 3%. Again, China stands out as really not having fallen anywhere near the level you might expect given the likely economic impact. But again, we've talked about all sorts of sectors that have been hit, banks and energy stocks the most. And clearly, if you're looking down a whole country, it's understandable why those sectors have been suffering.
Makes other European countries also probably rethink those open borders.
I'm sure it does. And just to come back to as well, we talked about the way in which US banks have been hit. Deutsche Bank, since its February high, fell 46%, I think it was, to the close. Now, it had a very strong run December into January, February before that, but it closed at or around all-time lows. So again, similar types of movers in European markets, similar types of sectors are taking the brunt of this, some extraordinary moves globally all round. Let's check in on some of the travel stocks, which, as we mentioned, have been in the eye of the storm. Travel websites down more than 5%. Trivago getting hit the hardest, down 17%, as you can see there. Bookings, Expedia, TripAdvisor all down over 5%. Our next guest says this hit to travel could also hurt ad-driven tech businesses like Facebook and Google. Laura Martin joins us now. She's a media internet analyst at Needham. Thanks so much for joining us, Laura. So talk us through it. The likes of Facebook and Google, perhaps more linked, do you think, to the coronavirus travel restrictions than so far has been priced into the stocks?
Yeah, so travel advertising, this is their peak period for advertising in anticipation of people traveling during the summertime. 70% of all travel advertising is online and 70% of that is in search. So Google is the big loser there, both in March and in the June quarter. We took numbers down. But Facebook is not only exposed to travel, it's also exposed to CPG and retail and entertainment, like the James Bond film being pushed off lowers advertising by 50 million, just that film being pushed from sort of near term to November. So that's about those four categories that are already showing lower advertising demand are 45% of total digital advertising in the U.S. and 30% globally.
Do you think it's already in the stocks, Laura?
No, because I think people are underestimating that when you have a revenue downdraft, they are 70% margin dollars. So there's a bigger profitability hit than people are thinking. And you probably saw that Microsoft, Facebook, Google are doing the kind and humanitarian thing. They are going to pay all of their hourly workers who aren't coming to work anymore because they've sent everybody home. So that's going to be great for the local economy, but it's going to really blow up their income statements even more than the downdraft in their revenue.
Laura, when you assess these stocks that you've covered for so long and know so well, do you think about the price to earnings multiple relative to the rest of the market? And do you adjust what's reasonable at moments like now when fear is spiking? Traditionally, these guys have had higher multiples, but when things are calm, that can be argued to be justified because their growth is high. Does that go out of the window at a time like now, or does it still apply?
No, it sort of goes out the window right now because we don't know where the bottom is. You know, when we get to a bottom, when this coronavirus numbers stabilize either in the U.S. or China or offshore, then we can look at where the bottom is. And at that point, we can assess what the corrections have been and start putting money back to work. But right now, there's so much uncertainty about the damage that coronavirus is going to do to consumer demand and to the market access, like can you raise any money in the equity or debt markets right now? And for how long are they is the window closed? That we have to see where those relative valuations are once it bottoms and consumer demand starts returning.
Is there any name that's relatively insulated from this? For Twitter, I didn't hear you mention, for instance.
No, I would stay away from all ad-driven stocks, which are fixed cost businesses with 70% margins. We like Peloton because people aren't going to a gym as coronavirus fears escalate. And it's a subscription business, and they have 1% churn. So once you get one of these Peloton bikes for any reason, even if it's to not go to the gym for a couple of months, you don't ever get off of it. So we really like Peloton as a defensive play in this market.
But are you going to go out and buy a Peloton if you don't want to go to the gym? Is that what's happening?
Well, I think people in our demo might be.
There we go.
I mean, we did see a move in the stock on that.
Defense, well, it's down today, though. But Laura, thank you so much for that.
My pleasure.
Let's send it back to Mike for his final dashboard of the day. Mike, what do you want?
Yes, markets are kind of fully in the mode of trying to handicap just exactly how much of an economic slowdown we get globally. This is the Goldman Sachs current activity indicator, so it's meant to be a leading indicator of global GDP. Keep in mind, not just U.S., but global. In February, this is as of the end of February, it was barely above the zero line, around 0.5%. And when we're talking about global, that's a steep slowdown. It's, the world grows faster, typically than mature economies like the U.S. So that is basically foretelling a first quarter print for global GDP somewhere under 1%. I guess the question right now is maybe bond markets have adjusted to account for something like this environment. But how long would it have to last at that type of near zero growth level for stock markets to really adjust? That's unclear right now. And I do think this is what a lot of people are focused on right now. We were sort of okay with this idea that we had a pause. But if it's something longer than that, then we might have to end with it.
To the global growth question, Mike, I think we should come back to this announcement from Italy. Because the Italian Prime Minister says, on top of what we said earlier, that the whole country is now in quarantine, all Italians should stay home, think of the common good and play their part to combat this coronavirus, cancelling all public gatherings, all sports matches. I mean, the market was down 7 or 8% today, and you look at that and say, what level of news headline do we need to create another shock to the downside? That's pretty extraordinary, and it will also raise that question, what will other Eurozone leaders do if they start to see numbers pick up and they don't want to be blamed for not being cautious enough? I mean, this is an astonishing move.
We're going to have to interpret to see if that's going to be an outlier response or not, and how do we guess that? It's very difficult to guess that. Now, I do know there's a lot of commentary that Italy has the oldest population in Europe, and it does disproportionately. The deaths have all been 60 and over in Italy. So I do think that maybe that has something to do with it, but it's certainly a little bit
I get that they have an aging population, but I'm afraid so does France, Germany, the UK, and the US. I mean, it's not like the demographics are attractive in any of those places. I do think the other theme that has come out from the commentary that we have seen as well from Prime Minister Johnson and others is to try and ease the pressure on health services in the short term and hope that they can manage it that way. But so far only Italy taking this action, and clearly their numbers are much worse as well so far.
When's that ECB meeting? On Thursday? That's going to be a tough one.
I mean, but to that point, we're saying the Fed perhaps might announce more overnight or whatever. What on earth is the ECB going to announce? What can they announce? It's almost lose-lose. Deutsche Bank's collapsed 46% in the last month. If we go negative rates, that's going to go further.
There's always tools in that box.
I'm not sure there is.
We'll see if she can come up with something.
She'd magic something up from nowhere, perhaps, but I'm not sure elsewhere. Let's have a look at how we finish the day on Wall Street. As we've said already, record decline in points for the Dow ever. In percentage terms, both the Dow and the S&P worst declines since various dates in 2008. 7.8% on the Dow, 7.6% on the S&P 500, 7.3% on the NASDAQ.
Incredible numbers. Will tomorrow bring more pain or relief rally? Bob Bassani is looking at some ETFs that may give investors clues.
Yeah, unfortunately, we don't have a lot of direction. Futures are still trading here. Just look at the S&P 500. SPY here still trades, closed at 274.23. I see it right now, last trade at 274, a little bit below that, 274 right now here. So let's call that relatively unchanged. Diamonds, Dow Jones Industrial Average, this is the ETF for that, closed at 238.72, now trading at 238.20. Again, very, very modest decline from the 4 o'clock close, and the triple Q 193.57 is where that changed hands last at 4 o'clock Eastern time. You see there 193.30. So modest, very modest decline so far. I agree with you, Wilf. I think these comments from the Italian the heads of state in Italy are absolutely remarkable at this point, and still not seeing a dramatic move though here.
Do you think that was priced into the market today, that we're expecting that to extend?
No, I don't, and I think that's quite extraordinary. I agree with your point here. So these are like rolling headlines. We're trying to get used to all of this on a daily basis. I think the only good news today is we did have that initial shock with the circuit breaker, and it served its purpose. The purpose was not to change the headlines. The purpose was to slow the market down for 15 minutes, gather liquidity, and it did that, and the market did lift, even though we closed at the ends of the lows at the end of the day.
So, Mike, what are we watching overnight?
Kind of reminded of Michael Hartnett at BofA has a saying he always goes back to, which is markets panic until policymakers panic. Maybe that's the next thing we're actually trying to hook ourselves onto, because over this phase, we've been able to say multiple times.
And it's not going to be the Fed this time, right?
Well, I think partially, but perhaps not all. I think the real policy response people are wondering about is congressional, is fiscal.
What do you look at overnight, Mike? I mean, Asian markets, obviously, but oil
Asian
prices.
markets and obviously yields. I mean, it went unremarked today largely that the Treasury yields did have some lift throughout the day. It's been a real sucker's game to try and call the final buying climax in Treasuries, but that is something to watch because they do trade, more or less throughout.
I think what we're going to have to watch for tomorrow. Obviously, we're not going to get a bottom in coronavirus stories, but some kind of indications of massive fiscal stimulus. I think the market would be much more impressed, and not just for consumers. It's not the consumer doesn't have money. The consumers have money. They're scared. Corporations need assistance as well, and I think that might help provide some kind of at least short-term.
Well, we're all going to be watching over the next hour Fast Money, which is about to start. Brian Sullivan here with us now, Brian, where really the heart of it all today was that shocking oil move, down what, 25%?
Yeah, you guys have noted, I mean, the biggest one-day slide since 1991. But again, not to belittle it, or belabor it, it's people say, well, who cares about oil? It's good, right? Gas prices are cheaper. The problem, of course, as I know you guys have talked about, and of course, Wilf, you cover the banks, it's really a debt and a credit story. It's an oil story as well. Oil, a small part of the stock market, but a much larger part of the credit markets.
Absolutely, Brian. I mean, it could become a debt and a credit story. I think that's the key question for the banks. They've fallen sharply like the oil companies, but as yet, unclear whether they warrant that level of fall or whether we'll see those types of debt issues. Either way, down sharply today. And Brian, we know you'll have all of the analysis covered. We're out of time here on Closing Bell. Over to you.
Yeah, we'll try to get some rest tonight, guys. We'll see you tomorrow morning. Nice and early, Wilf and Sarah. Thank you very much. All right, everybody, welcome to Fast Money. I am Brian Sullivan, and your traders on this very important night tonight are Tim Seymour, Steve Grasso, Karen Feinerman, and Guy Adami. All right, we're going to get to that in just a second. It was, meantime, a record day on Wall Street, and for many, a day to forget. All three major averages plunging more than 7%. The Dow, the biggest loser, falling 2,013 points. That is not a misquote. That is the largest point drop ever and one of the top 10 biggest declines on a percentage basis ever. The transports crushed, falling nearly 10%, their worst day since all the way back in September of 2001 on 9/11. Obviously, don't need to remind you what happened then. Today's losses fueled by that crude crash that we just discussed. The energy sector having its worst day ever as well. Oil losing roughly a quarter of its value. Crude is now trading just below $31 a barrel. Many oil and gas stocks down 30 and 40% today as the market assesses simply many of these companies' ability to survive in a lower oil priced world. And one more incredible stat for you on this incredible day. Interest rates continue to collapse. The yield on the 10-year Treasury note hitting a new low of nearly 0.3%. Well, following yesterday's sell-off or today's sell-off, S&P 500 stocks have lost a total of $5.7 trillion in market cap just since the record high on February 1st. There is your setup. It was, by any measure, an historic day. Guy Adami, I know you were on Power Lunch as well. Welcome, everybody, on this big day. We are commercial-free, by the way, through the entire hour. And this is a night, Guy, where we don't need to really get complicated. It's a question of what happened and what do we do now? Do you really believe that the drop in oil is what triggered this market today?
Well, it's obviously a big part of it. You can't discount the fact that when crude moves to the extent that it moved, given the moves it already seen, it obviously had a lot to do with it. And that's stoked the fears as well. But again, a lot of this has been in place for quite some time. You know, bond rates, the bond market shouldn't move like it's moved over the last year and a half. And I'm not saying that today. We've been saying that for quite some time. The volatility in the bond market was striking. Nobody really talked about it because it's not equities. You know, if we had that kind of, half that kind of equity volatility, it would be front page news every day. Currency is the same thing. Tim speaks to that all the time. Now it's finding its way into the equity market after a long period of time. I happen to think, as painful as this is really a good thing. The market needs this. I'm not suggesting it's over. I think you know when it's over, and this is just my opinion, when you see some big either hedge fund or derivatives book or some sort of bank with a huge derivatives plays, when they blow up. When that happens, we're close. It hasn't happened yet.
I saw some data today, Tim, that in some ways average volume was higher than during the peak of the 2008 collapse. The action was fast and it was violent.
Dollar volume certainly would be based upon the levels we're at in the market. But the velocity of this, pick your asset class, every single one. So, you know, to the intraday low on the S&P, we were down about 19% in 12 days. Guy mentioned the reference to the dollar being down about 5.2% in 12 days. The yen strengthening, which we all know is kind of this unwind of carry trades. That's part of the dollar's move, by the way. And without getting too lost in that, those are, you know, that yen move is a massive risk off move. That's almost 10% move in the yen in 12 days. So, look, there's different fires going on around the world and in different asset classes, frankly. And I think oil over the weekend was the latest black swan in the middle of, you know, what might be a group of foul. There is a credit dynamic that is emerging out of the energy space that we all knew was there. And if you talk to credit traders in energy and in high yield, they'll tell you that actually, you know, where they're seeing the market right now is inside of the lows of 2018 December and more likely nearing the lows on spreads right now of 2015.
And we'll get to more on energy with Mike Bradley at TPH, one of the best, if not the best in the business. But Steve, I want to start off with you. And we had a circuit breaker hit. Right. It fell 7%. I think it was 3 minutes after the open on the S&P 500. Stopped for 15 minutes. What was that like? You're on the floor. What was that
Panicky.
like?
It's not every day you deal with a circuit breaker. And you
had it 3 times in 20 years or something like that?
3 times. And when you have it telegraphed, where last night we're limit down in the futures, that was a big deal. And everyone was waiting for us to get dropped to the next level, which was down 13%. So I think we're starting to see shades of panic. But I'd rather have this panic in the oil market than in the financial markets, in the banks, if that makes any sense.
Didn't we have that today a little bit?
You had it, but there's not a balance sheet panic. There's a stock price panic. And I think those two things are completely different.
Yeah, because, and I think we have a graphic on this. Goldman Sachs put out a note late today that I got, and it's basically energy's exposure to the banks, and it's small. I think Citigroup was the highest
3%.
at about 3%. You've got Bank of America at about 2%. So on an absolute basis, Karen, we're talking about a fairly small portion of the balance sheet.
So I don't think that's
Or their
really
loan
what was
books, I
going
should
on
say.
today. I mean, the market was down, so of course everything would be down. I don't think it was oil. I think it was more this idea of rates, of course, that always, is difficult for the banks, but this idea of a recession and credit quality. And what does that mean if we have a slowdown? What does that mean to their entire book of lending? Forget oil. The rest of their lending. If you look, Bank of America, I think, is maybe among the hardest hit. They have a very big consumer book. So that's what I think, aside from the market, aside from rates, aside from oil, which really is the last one, the smallest element of the move.
Because take us into that, because I think this is a really important point to make, because it's not just about the move today, it's about what happens going forward. There's the data. Citigroup, 3.2% of their order book, according to Goldman Sachs, Wells Fargo, 1.5%. Those are small numbers relatively, but we're still talking $15 and $16 billion in the case of Citigroup or maybe JP Morgan Chase. And so is the idea, Karen, what you're talking about, if those things start to suffer, the chance of them lending money to businesses, giving you a mortgage, all that stuff starts to shrink a bit.
Not because of the oil exposure, I don't think. Because of the rest of the book is so much bigger that, if you're going to have businesses that are really starting to have trouble, that's, I know JP Morgan, all the banks want to be, they want to be a good partner, but at some point, you don't want to extend credit that you don't think you're going to get back. So that's what I think was weighing a lot, plus rates and a market that was down.
And I think today was the big fear day, right? I mean, everyone felt afraid, and you had so much of that set up last night when you're watching the futures limit down. And then when you hear Governor Cuomo, though, I think he put it in perspective rather well when he said we're battling more fear than the virus. And I think we're not scientists, we're not MDs, but to me it seems like the market's trying to factor all of this in, and I don't know where the chips finally fall, but it seems a little overdone to me.
Well, listen, Steve, fine, but we just had, you heard Wilf and Sarah say it, that the Prime Minister of Italy is trying to shut down the entire nation.
Right. I think
Hold on. It's the ninth biggest economy in the world.
So let me just real quick. So I think what Wilf is saying, though, too, is that countries are trying to outdo each other with what they're shutting down. It's the same thing with S&P 500 companies. They're shutting down visitors. They're shutting down cafeterias. And if you don't shut down, you seem like you're being cavalier, and God forbid something happens and you're to blame for it.
Yeah.
So I think we're in a race to shut down the world
fair,
right now.
Fair enough, but that's not for us to judge here. Our job here is to analyze the economic backdrop, Guy Adami, and say, if we see a significant reduction in travel, driving, commuting to work, an economic slowdown, we have no idea what growth rates are going to be, if we have growth, and what corporate earnings are going to be. And maybe this is a stock market that reflected the idea that simply they don't know anything.
Yeah, I hear what Steve is saying, 100%. And we have a lot of time, which is good. I mean, I think the coronavirus, a lot of people say it's the cause. That's fine. Everybody's entitled. I think it's just was sort of the final match on what has been a tinderbox, and that set it off. With that said, the S&P 500, I think at today's close is down 19 or so percent from the recent all-time high. It's a pretty big number. People will say the market's cheaper now. That might be true. I'd push back and say I can make an argument, and I'm not, again, I don't know this, but I can make an argument that stocks might actually be more expensive today than they were at the all-time high.
Because we don't know any of the multiples.
How can you possibly, now I'll say this quickly, 73% of this economy is driven by people buying things, going places. People are not